economy holds almost approximately 15 to 20 questions. So joining us today, sir will be available in just a few moments. Hopefully, you have your PYQ questions with you. Please keep a pen and paper along with you so that when the questions are being solved, you guys can also practice it on paper. All the best, guys.
So the idea is clear. We will try to cover as much as possible uh, within a span of, let's say, 4 hours, which we are allotted. Okay. And I will try to give some more details which are important. For example, let's say, with respect to every topic, are there any other areas which are important? For example, something that is in news, or something that was asked in CDS exam recently. So we'll look into these things also. Okay, so I think the screen is visible. Okay. So here we see the first topic here, macroeconomy. As such, we find few important things here. One is in the macroeconomy, there were questions related to GDP, national income. Okay. And there were also questions related to inferior goods. Of course, inferior goods, etc. These things purely come under micro. So there were different questions that were asked. So going by the question model, so what we are doing is we are first looking into the question and then trying to hit the question. Okay, so and then we'll discuss some concepts related to the question. Okay, so here, if we look at the first question here, this was a question that was asked in 2024. I think it is visible to everybody. Okay, so this is basically related to this concept of bonds. So with respect to the concept of bonds, what are the questions that were already asked? So let's try to see what are the questions that were already asked. So there were questions like, what are the factors that will affect bond yield? Factors that will affect bond yield. This was one question that was already asked. Okay, and the options that were given earlier were, one is the interest rates, then the federal bank policies, inflation. So these were the options that were given. Okay, and then there were questions on masala bond. You can see there, I've written something like masala bond here. Okay, and then there were questions on inflation index bonds earlier. There were questions on FCCB. FCCB is foreign currency convertible bonds. Okay, FCCB is foreign currency convertible bonds. And then recently in news is the additional tier 1 bonds. That is the AT1 bonds in news. So which was issued by SBI. So can anybody tell me what is the relationship between bond price and bond yield? Just looking at the chart. Okay, so can anybody, if you don't want to speak out also, you can just write it in the chat box. What is the relationship between bond price and bond yield? Is it directly proportional or inversely proportional? Okay, so inversely proportional, right, right. So bond price and bond yield are inversely related. Good. So there is an inverse relationship between bond price and bond yield. Okay, inverse relationship between bond price and bond yield, right? And another important observation here is recently, if you are reading news, US bond yields were our last 10-year data shows that US bond yields last year were one of the highest in the last 10 years. So Donald Trump also wanted to reduce the yields indirectly. So how do you reduce the yields indirectly? So Donald Trump wanted to reduce the yields indirectly. How do you reduce the yields indirectly? By increasing the bond prices. Now the question comes up then, how do you increase the bond prices? So bond prices will be increased basically by more people buying these bonds, US bonds. That means US stock market, if it is not going to do well, then people start investing into bonds. And when they buy bonds, the bond prices increase, and therefore the bond yields are going to decrease. Now, what is the benefit of bond yields going down for Donald Trump? So he wanted to refinance new debt at lower rates. So I think you should be knowing what is the link between interest rates and bond yields. What is the relationship between interest rates and bond yields? Okay. So fine. So let me explain one or two concepts here. Okay. So first thing is inverse relationship between bond price and bond yield. Everybody knows this, right? So whenever a bond is issued, let's say 100 rupees, let's say this is the face value of the bond. The coupon would be announced for this bond. Let's say coupon is 10 rupees or the coupon rate is 10%. Always you should be knowing that this coupon is always on the face value and it is fixed. Okay, so this 10% of this 100, that is 10 rupees annually, let's say this is what they paid on annual basis. Okay, so what is the yield here? Annual yield here, it is 10 out of 100, which is equal to 10%. I think everybody knows this. Okay, so anywhere you want to stop, you can speak out because right now I'm not able to see this Zoom screen. I'm just trying to explain you the concept, which you already may be knowing, but there are some other things which I wanted to mention here. Okay, so this is basically the face value. Now this bond, let's say, is sold in the market. Okay, and now somebody has purchased this bond at 90 rupees only. Now this is the bond price. What is this then? This is the face value of the bond. Now this is the bond price, but the coupon of the bond remains the same. Coupon is always on the face value, which is the same. So coupon is 10 rupees. So now what is the yield? 10 out of 90, because my initial investment is 90 rupees. Okay, so it is around 11.1%. That should be clear. So that means when my bond price reduced from 100 to 90, bond yield has increased from 10 to 11.1%. So this is how we have arrived at this logic of bond price is inversely related to bond yield. Okay, now few important aspects here. Okay, so when we talk about a regular yield curve, okay, so if I'm taking bond yield on my y-axis and I'm putting maturity period on x-axis. Maturity period of the bond on x-axis. So the regular yield curve, this is what is a regular yield curve. So that means as and when maturity of the bond is increasing, bond yields will increase. That means long-term bonds generally should give us higher yields. Okay, let me explain the concept and then I'll take your doubts. Okay, so this is the first graph. This is a regular yield curve. Okay, sometimes what can happen is there can be a flat curve. Now, this is what is the flat curve. That means irrespective of the maturity period, whether it is 1-year bond or whether it is 10-year bond, the yield is almost the same. Okay, so now the recent discussion is about this aspect, which is, we call it as the inverted yield curve, which was seen in US Treasury bonds. So US Treasury bonds, we could see an inverted yield US Treasury bonds. There was an inverted yield curve. You can see it, inverted yield curve means the long-term bond is giving lesser yield and the short-term bond is giving more yield. So it is a reverse to the regular yield curve. Okay, and this inverted yield curve in US is an indication that recession is at its doorstep. So this inverted yield curve, which is approaching, okay, inverted yield curve will be seen in the US bond market before the recession is announced. So what is recession basically? It is a negative growth for 2 quarters and above. That is what is recession. Okay, so before 2008 recession also, there was a bond yield inversion in the US Treasury bonds. It's an indicator that, okay, so it is an indicator that you will find that it's an indicator that the recession is about to come in US. Okay, so this is what we have to understand. One is the inverted yield curve is an indication that recession is at the doorstep of US. Now, let me ask you one or two questions here. So hope you're able to, so long-term and short-term bond, see, I hope I'm visible now. So long-term and short-term bond, basically long-term bonds are those bonds where the maturity periods are generally greater than 1 year. So in India, we use the word dated securities. Okay, so short-term bonds, generally, we talk about those bonds whose maturity period is less than 1 year. Okay, so we'll come to that, like the treasury bills, etc. Fine. So generally, whenever a long-term bond is issued, there will be a higher coupon announced. Higher coupon announced. So why? Because otherwise there's no point. No? So FD is there. FD will pay you higher interest than the regular treasury bills. Okay, so why FD is paying you higher? Because you're keeping your money for a longer period. So this is the logic behind basically higher on the face value of the bond, higher interest would be mentioned. Higher coupon would be announced. So that should be very clear. I hope everybody has understood that. Okay, so is this clear, everybody? Satish. Okay. So can I start writing again, or any doubt you have here? Okay, so I think this is clear. So why inverted yield curve will talk about recession is because whenever recession is about to come, what people do is they remove money from long-term, they remove money from short-term bonds. These are short-term bonds here. I think the arrow is visible here. So these are short-term bonds, 1 year, 2 year bonds. They will remove money. Why should they remove money here? They should remove money here because these bonds basically, whenever there is a recession in the short term, there is a higher risk. So I will remove my money from higher risk instruments and put it into long-term instruments. So you're removing money from short-term instruments. When you remove money means what? You're selling off short-term instruments. So when you sell off short-term bonds, when you sell something, what will happen? Everybody's selling the share or everybody's selling the bond prices will come down. Similarly, the bond prices or share prices will come down. So here also everybody's selling of short-term bonds means the bond prices of short-term bonds will come down. When the bond prices come down, then what will happen? When the bond prices come down, the bond yield, this graph moves this way. The bond yield is going to increase. So this is an yield. On y-axis, we have taken yield. Okay. And they are parking their money in long-term bonds. So parking money in long-term bonds means you're buying long-term bonds. So when you're buying long-term bonds, long-term bond prices will increase. That means long-term bond yields should decrease. So this is what is the question. So that is the reason you find an inversion. So investors are already trying to play safer because they're estimating recession, which is about to come. And that is the reason bond yield inversion, which is that yellow line which you see there, is an indication that recession is at the doorstep of US. So, fine. Okay. So moving forward here. Now, this was the question that was asked. US were to default on its debt, holders of treasury bonds will not be able to exercise their claim to receive payment. So what about this question? Anybody? Can you push the answer? US were to default on its debt, holders of US Treasury bonds will not be able to exercise their claim to receive payment. Second statement, US government debt is not backed by any hard assets, but only by the faith of the government. So what should be the answer for this question? Students, you have the document with you. This document is there with you.
No, sir, this has not been shared. We'll be sharing it post the class.
Okay. So then you can please check the question again. I'm putting it on the screen. Those who would have solved the previous questions also, you should be able to answer this question. Are you able to see the question? Yes. So, yes. So A is the answer. So such questions when we get doubt in the exam hall. Okay, so what has to be done? Two things can be done. When I read two statements together, they are aligned with each other. That is what you should understand. Now, some people were saying, yes, see, you can go to the court or something when somebody is not adhering. But the question here is, if US were to default on its debt, holders of the treasury bonds will not be able to exercise. You can't exercise your claim to receive payment, as simple as that. Later on, you might go to the court, but since these assets are not backed by any hard asset, these bonds are not backed by any hard asset. Okay, so only by the faith of the government. So immediately you will not be able to exercise your claim to receive payment. This is the first thing that will happen. Okay, so why? The reason being, US government bonds are not backed by any hard assets, but only by the faith of the government. As simple as that. Okay, so this is some understanding, and both the statements are okay. And the second statement is explaining the statement one. Now, some questions which were already asked was about masala bonds. So what are these masala bonds? These are rupee denominated bonds issued in other countries. Okay. So why do we issue these masala bonds is the question. So when you issue bonds in US, so generally we issue bonds in dollars, generally. So when you issue bonds in dollars, what is the problem? Those investors who are buying these bonds, is there any issue for them? Can somebody put it in the chat? Or if you want to speak, see if you issue regular bonds in US and you're raising money and you're issuing bonds in dollars, what risk is there and who will face that risk? You can put it in the chat. What is the risk involved? If you're issuing bonds in the foreign country in foreign currency, what is the risk involved? So somebody is saying currency fluctuation. So depreciation of rupee. So what will happen? The issuer of the bond. Okay, fine. So we'll be a little fast now. See, X is there. X is issuing bonds in US. And this is issued in dollars. You have investors in US who purchased this bond by paying dollars. And these investors will receive interest in dollars as well as the principal also in dollars. So these bonds were issued by X. So who's X here? X is the borrower. or X is somebody who is the debtor or the borrower, the company. They are the investors into the bond and or lenders, we can call them as. Okay, so the problem is when bonds were issued when $1 was 75, now $1 became 85. So this is a currency risk. So therefore, interest has to be paid. And when you're paying interest in dollars, the loan is becoming costly for X. This is what we call it as the currency risk. This is what is currency risk involved. So what does masala bond do? What is masala bond? Masala bond is basically rupee denominated bond. Okay, so these bonds will not be issued in dollars, but in rupees. So what is the benefit? Now interest will also be paid in rupees to the investors, these investors. Principal is also paid in rupees. So because of that reason, the currency risk is not eliminated. Currency risk has been shifted. Currency risk has been shifted from the investor, that is from the debtor. From the debtor, the currency risk has been shifted to the investor or the creditor. IFC, which is a wing of World Bank Group, is the first entity to issue masala bond. This was the previous question that was asked. So this is about masala bond. Now, one question to you all. There was this question already asked, FCCB, foreign currency convertible bonds. So the question that was asked in UPSC was something like, which of the following is part of FDI? That was the question. And options were given. What were the options that were given? Options that were given were, which of the following were part of FDI? Options that were given were FI with certain conditions. That was one option that was given. Okay. FCCB bonds, foreign currency convertible bonds, GDRs, third option, and NRI deposits. Four options were given. Okay, so answer for the question is obviously FCCB bonds can be treated as part of FDI. FI with certain conditions, that is in a listed company, if the portfolio investment is greater than equal to 10%, that investment would be treated as FDI. GDRs, as per FEMA guidelines, GDRs are also treated as FDI. As per RBI guidelines, GDRs are treated as FPI. So this is something which you have to understand. Even when it comes to FCCB, now somebody will tell me, what is this FCCB or a foreign currency convertible bond? You can put it in the chat, or you want to speak, you can speak. Whichever is convenient for you. What happens in FCCB? Yes, what happens in FCCB? Nothing. How does an FCCB operate? Anybody? Foreign currency convertible bond. Okay, convert bonds into stock. That is okay. Who will issue these FCCBs? Who will issue FCCB? Yeah, Tarun, who will issue FCCB? Okay, so FCCBs are bonds issued by Indian corporates. Okay, so they're issued by Indian corporates. And the word itself, when you say FCCB, it is a foreign currency convertible bond. That means it is issued for somebody who's outside India. And it is issued in foreign currency. As simple as that. Now, it's a convertible bond. Some portion of this FCCB can be converted into equity. And some portion remains as bond only. And that portion which is converted into equity, that portion will be treated as part of FDI. that portion which remains as debt instrument only, that will be treated as part of ECB. So, which of the following can be seen as part of FDI? This was the question. Can be seen. That means, yes, FCCB can be seen, but going too specific, that portion of FCCB which can be converted into equity will be part of FDI. And that portion of FCCB which remains as a debt instrument or a bond will be ECB. Okay, so that is about. So as and when the other questions come up, I'll talk about IIB. Okay, so fine. So now this is an easy question. Which of the following activities constitute a real sector in the economy? So first of all, real sectors are those sectors which produce. And the nominal sectors are support systems which support the real sector. Okay. So basically when I say financial sector is going to support the real sector. So the core production activities are basically part of the real sector. Okay, so in this question, farmers harvesting their crops, obviously it's a real sector. Textile mills converting raw cotton into fabrics, that's also real sector. But commercial banks lending money to a trading company or a corporate body which is raising money through bonds, these are basically not real sectors. You're raising money for supporting the real sector. So those sectors which support the real sector are basically the financial sectors here. So based on that understanding, you should be knowing that the answer for this question is 1 and 2. I hope there is no confusion in this question. Okay. So wherever there is more of a complex topic involved, we will spend more time. Like for example, bonds. And okay, so after some time, you'll also tell me what is the impact of inflation on bond yields. So previous question was what? What are the factors that will affect bond yield? So like inflation will affect bond yield. So what you will tell me after your research, maybe after some time, is if inflation increases or inflation decreases, what is the impact on bond yields? This is one. Another important observation is in US, if there is a hawkish policy, everybody should be knowing hawkish policy. What is hawkish policy? Anybody? You can put it in the chat. In US, if the Federal Bank of US is coming up with hawkish policy, what is hawkish policy? Is hawkish policy a tight monetary policy or easy monetary policy? Yes. US is currently following a hawkish policy or a dovish policy. What did the Federal Bank do with respect to rates recently? Did they change or did they keep it as it is? Okay. Okay, so hawkish policy is a tight monetary policy. Okay, so when I say tight monetary policy, in US, the interest rates are going to be increased. Okay, so interest rates are increasing means the bond yields in US will also increase. So safe instruments like bonds in US are giving higher return. So those investors in India also, they will park their money in US bonds. Because of that reason, there will be flight of capital from India. Flight of capital means money will start moving from Indian market to the US market. So that means the dollars start moving from India to US. Okay, so if dollars start moving from India to US, that means Indian bonds they will sell, and let's say they're investing in US market. So in a selling of Indian bonds, that means Indian bond prices will come down, and therefore Indian bond yields will increase. So if there is a hawkish policy in US or a tight monetary policy in US, there is a higher probability of bond yields increasing in India. Higher probability of bond yields increasing in India. Have you understood this? So first of all, hawkish is basically tight monetary policy. Dovish is easy monetary policy. In India, we talk about expansionary, contractionary. Hawkish is more like contractionary monetary policy. Dovish is more like expansionary monetary policy. So recently, you know that RBI has reduced the repo rates. CRR also has been reduced. All this is done because of multiple reasons. One is the growth indicators. You want to target higher economic growth. Inflation is low. Today's paper also, if you see, you will understand that the inflation is at a lower level, and that is basically because of fall in vegetable prices. Okay, and therefore you can come up with reducing the interest rates. And CRR was also reduced in the recent past. You should be knowing that CRR was also reduced from 4.5 to 4 because of high credit to deposit ratio. High credit deposit ratio. Okay. Fine. So these are some things which are there in news. For example, high credit to deposit ratio or liquidity crisis of banks. This is what is there in news. Liquidity crisis is there with the banking system right now. So that is a crisis right now. To handle the liquidity crisis, several measures have been taken by RBI recently. That becomes important for the exam. So you can go back and check what measures RBI took for injecting liquidity into the Indian economy. Okay, so injecting liquidity. One measure is obviously reducing CRR. Another measure is foreign currency swaps with banks. RBI signed foreign currency swaps with banks. So what is the meaning of foreign currency swap with banks? Okay, so RBI is buying dollars from banks. RBI is buying dollars from banks and giving them rupees. Okay. With an agreement that after 36 months, that is after 3 years, banks will again buy back the dollar. So that means why is RBI buying dollars from the bank? Because you're buying dollar and giving them rupees. They need cash. Banks need cash because banks are facing liquidity crunch. So this is called as forex swap. Okay, with the banks. Forex swap with the banks. Okay, so that is one thing that they have done recently. Okay, so that is forex swap. Okay, fine. I think till there's no problem. Okay, so now, which of the following is most likely to be taken at the time of economic recession? So whenever there is recession, you have to follow expansionary fiscal policy and expansionary monetary policy. So based on that logic, you will tell me the answer for this question. So obviously, increase in tax rates should not be done. Reduction of expenditure, you have to increase expenditure because expansionary. Cut in tax rates accompanied by increase in interest rates. No, you have to reduce interest rates. Okay, so obviously, what should be the answer for this question? Anybody? You're able to see the question? If you're able to see this question, please try putting the answer. That's a simple question. So there should not be any trouble. Okay, so this is the answer. Okay, so that's a simple question. Okay, so it is liquidity injection, right? Now see here, of course, we have to not look into the previous question. What we have to see is what can be asked. Okay, so in CDS, there was a question about perfectly elastic supply. Okay, so there was a question about perfectly elastic supply. So everybody knows supply and demand graphs. But what was the question that was asked in CDS paper? Give me a second. I'll just draw and show you. Okay, so basically to understand some microeconomic concepts that can be asked in the exam. Okay, so first thing is okay, so here I'm taking price and quantity demanded and quantity supplied. So all other things remaining constant, demand is inversely proportional to the price. Okay, similarly, all other things remaining constant, the supplier wants to supply more material at higher prices. This is the supply graph. This is a basic supply graph. Now, this intersection point is how you arrive at the price. Okay. And this is the price where the quantity demanded is same as the quantity supplied. Okay. So this should be clear. There should not be any confusion for anybody. Now the question, of course, the question that was asked in CDS is, suppose this is the demand graph. Okay. So you see the demand graph here. Now, suppose this is the demand graph. Anywhere on this demand graph, the demand is changing. It is purely because of which factor? It is purely because of the factor that is price. What about if the demand changes because of some exogenous condition other than the price? Exogenous condition other than the price. Then you will find if the demand increases, for example, your income is increasing or government has come up with liquidity injection or whatever, then there will be, it's an exogenous factor other than the price. Then the demand, you will find a rightward shift, or if the demand reduces, then you will find a leftward shift of the demand graph. This is a rightward shift. Now the question is, how does a perfectly elastic supply graph look like? Anybody? Okay, so let me see your chat. How does a perfectly elastic supply graph look like? So the question that was if there is a perfectly elastic supply and there is an exogenous change in demand, that means rightward shift of the demand graph, then will there be a change in price or will not be a change in price? And will there be a change in quantity demanded or will there be no change in quantity demanded? This is the question. So here you can see this. Okay, so this is exogenous. There is a demand increase, but this is a regular supply graph. How about a perfectly elastic supply? How does a perfectly elastic supply graph look like? Anybody wants to try? How does a perfectly elastic supply graph look like? So it's very important that you go through CDS and CAPF questions also, because some concepts might get repeated in the UPSC prelims. We need to be fast. Also, we're going slow. First 1 hour probably will be a little slow. You're not answering, therefore we are going slow. I want you all to increase. Anybody wants to try perfectly elastic supply? See, perfectly elastic supply means basically you will find that the graph would be parallel to x-axis. So what does that mean? At this price, the supply is going to infinity, but with slight change in price, the supply completely changes. Slight change also in price. This is what is perfectly elastic. Perfectly inelastic would be parallel to y-axis. That means irrespective of price, any price, you are going to supply so much. Okay, so irrespective of the price. Now, perfectly elastic is at this price, let's say you're supplying up to infinity. With slight change in price also, there will be a complete, it might become zero also. This is not a perfectly elastic supply. So when there is a perfectly elastic supply and there is an exogenous change in demand, exogenous change in demand means the D has, this you can observe what I'm writing here. Let's say this is D, this is D dash. You moved from D to D dash. Okay, and perfectly elastic supply. Now this is the intersection point. But did the price change? Though the demand graph might change. So here if you see, let's say the demand graph again changes. Okay, but the price does not change here. Your price remains. Okay, but what about quantity demanded? Quantity demanded changes. Okay, so that is what was the question. Okay, so perfect. Then comes some exceptions to the regular law of demand. So everybody knows the regular law of demand. So regular law of demand, this is the regular law of demand. Okay, so regular law of demand, you have price and quantity demanded. Okay, so here there are some exceptions to regular law of demand. One exception is the Veblen goods. So Veblen goods are luxury goods. They are an exception to the regular law of demand. That means as the price is increasing, the quantity demanded will increase. Price increase, quantity demanded will also increase. Then there is Giffen's paradox, Giffen goods. These are also an exception to the regular law of demand. See, Giffen goods are a of subset of inferior goods. Subset. Inferior goods directly don't show inverse relationship, or inferior goods don't directly go against the regular law of demand, but Giffen goods, which is a component of inferior good, will show is an exception to the regular law of demand. So Giffen good is what? For example, Giffen is not obviously Veblen. So Giffen goods graph also, what you'll find is, let's say if this is the price and this is quantity demanded, let's say potato, and there is a lot of let's say in some places in India, potato is a staple food, and potato prices were increasing. Now people stopped buying rice, wheat, etc., and they started buying potato, though it is costly. That means what? You will find that the graph is going in the reverse direction. Okay, so that means though potato prices are increasing, the quantity demanded of potato is increasing. Now this is what is the Giffen's paradox. That doesn't mean Giffen goods are luxury items. They are not luxury. Veblen is luxury. Giffen is a subset of inferior good only. But Giffen's paradox talks about this relationship. Okay, so it shows a relationship which is completely different. Okay, so we should know inferior goods. We should know Giffen goods. We should be knowing Veblen goods. Okay, inferior goods, basically what happens is, as and when income is increasing, the demand for these goods is going to come down. For example, let's say Nano, of course, Tata Nano does not fit into pure inferior good. But what will happen is, if let's say income is increasing of public, they stopped buying Tata Nano and they started shifting to Maruti Alto. Okay, so that means what? As income is increasing, generally the demand should increase. But for the inferior good, as the income is increasing, the demand is dropping. I hope you're able to understand these words. Are you there? Students, are you following? Okay, okay. So you just, if you're following, just put it in the chat so that I'll get to know, because this is not a live class, not live in the sense I'm not teaching you down. So therefore, I have to switch on the screens. That is the reason. Okay, so I think this explanation is clear. These are the concepts which you should be knowing. And perfect elastic supply, perfectly inelastic supply. That means inelastic would be parallel to y-axis, if at all in UPSC prelims, if he's touching that. Okay, so that concept should be clear. Okay, now let's go to the. Okay, now this was the question. This question, there should not be any problem. Other things remaining unchanged, market demand for a good might increase. See, if the price of its substitute increases, okay, price of its complementary. Suppose, let's say, car and petrol are complementary and car prices are increasing. So petrol demand, will it increase? No. Car prices are increasing, and then less sales of car, then less demand for petrol. So this can't be there. Okay, the second one. The good is an inferior good and the income of consumer increases. So what you should understand, inferior good is an inferior good and the income of the consumer increases. So if the income of the consumer increases, the demand for inferior good decreases. Nano example. Okay, so this should not be there. Okay, so now tell me the answer for this question. See the question. So from this question, these are the concepts you have to learn. Price of the substitute increases, price of its complement. What is the answer? Its price falls. Can I see your screen? Yes. Yes. Good. Okay. So 1 and 4. But concepts to be understood, Giffen and Veblen, they are an exception to regular law of demand. Then perfectly elastic, perfectly inelastic supply. And then on the demand graph, if the demand is changing, it is because of the price. But if there is a rightward shift, leftward shift, it is because of an exogenous condition other than the price. Other than the price, exogenous condition can be what your income is increasing, or parents have sent you more money, or government has given tax concessions. These are all exogenous conditions. Okay, so good. So that is the concept. Now there is this question. This is a factual question. See this question. For such questions, if we know, it's okay. Otherwise, some common sense logic has to be used. Okay. This is a factual question here. See here, worker productivity per worker increased in urban while it decreased in rural. Okay, so actually, worker productivity increased in urban as well as rural areas after liberalization. Okay, so worker productivity. Okay, so now, so here the concepts to be understood, I'll come to that. Now, second statement, the percentage share of rural areas in the workforce steadily increased. In rural areas, the growth in non-farm economy increased. Now, what about the third statement? How many of you feel that the third statement is okay? Common sense. The growth rate in rural employment decreased. Growth rate in rural employment decreased. See this rural share in the workforce decreased. Percentage share of rural areas in the workforce steadily increased. Rural share in the workforce decreased because people started moving to urban areas. Okay, so that is something which should be clear. Okay, so that means the first statement is wrong. Even the second statement, there is a trouble. What about the third statement? Rural areas, the growth in non-farm economy increased. Growth rate in rural employment decreased. Okay, so growth rate in rural employment decreased. So what is the answer for this question? I hope you have seen the question, everybody. Yes. Good. Okay, so good. So you know the answer, very basic. So you are able to figure out. See, before we get into government budget and other things, so some concepts which we have to understand. I'll keep on asking you the questions. You push it in the chat box. If you are able to mark it, I'll not explain the concept. Otherwise, I'll go to the concept. Okay. So first question to you all. Are transfer payments part of national income calculation? You just put yes or no, based on which so this is all part of the macroeconomic discussion only. Okay. So first question to you all. Are transfer payments part of the national income calculation? Put it yes or no in the chat box. Okay, so no, transfer payments are not part of national income calculation. Very good. Are transfer payments part of personal income? Put yes or no. Are transfer payments part of personal income? For the second question, I want your answers. Yes. So transfer payments, good. So transfer payments are part of personal income, but transfer payments are not part of national income. Very good. Okay. Very clear. No confusion. Okay. Now, next question to you all. Goods produced for own consumption are they part of my GDP or national income calculation? Goods produced for own consumption, are they part of national income calculation? No, you're wrong. You can use your mobile to check the answers also. Goods produced for own consumption are part of national income calculation. Very important, huh? Goods produced for own consumption. Suppose let's say a company is also producing a machine, and that machine is used by the company. Okay, so a company is producing a machine is used by the company, right? That will be part of national income calculation. Remember this. Okay, got the point, right? So goods produced for own consumption. Fine. Then if you are buying some shares, or let's say TCS is buying shares of Wipro, is it part of the national income calculations or not? If somebody is buying some shares of a company, let's say TCS buying Wipro, you're buying some shares, is it part of national income calculation or not is the question. So for this question, put the answers, everybody. If you have some doubt, then and there use mobile. You can use mobile if you're getting a doubt. If the question is clear, I'm buying some shares. Okay, I'm buying some shares. Are they part of national income calculation? No, they are not part of national income calculation. Remember this, they're not part. Okay, fine. Then a tourist is coming to India and is buying he's purchased some shirts for himself. Okay, so where will this go in my expenditure method of calculation? Expenditure method of calculation, I think everybody knows C plus I plus G plus NX. So in the expenditure method of calculation, a tourist is coming and buying a product. So where will this go in that C plus I plus G plus NX? Wherever there is doubt, you can tell me, there I will explain. So C plus I plus G plus NX, the tourist is coming and he is buying a textile or a cloth or maybe a shirt, whatever. So is it part of, where will it go in that C plus I plus G plus NX? Yes. Got the question? C plus I plus G plus NX, which is the expenditure method. Tourist is coming. He is buying a shirt. Where will that go? Is it part of C? Is it part of I? Is it part of G? Where does it go? No, it is not C. Okay, so tourist is coming, buying a shirt. It is not part of C. It is treated as part of exports. It is not G. How can it be G? Okay, so it's not government. Okay, so 1 second, I'll write it. So you can use the mobile phone now, and you can use the mobile right away. Use the mobile phone right away and tell me the answer for this question. Be faster, we don't have time. Okay, so tourists coming to India, buying something, buying a shirt, where will it go in my expenditure method of calculation? Tourists from some other country is coming. It is X, it's not C. That was a previous question. It's not a new question. It's not my question. It's a previous question. It is part of export. That's good. Okay, good. Export component. See, something that is there in the previous question, you should be able to mark. Okay, let me write. Let me write few things here. So we can't discuss the whole of national income, obviously, but wherever I feel that, yes, there can be a question, or wherever there can be some confusion. Okay. So, one is transfer payments, everybody knows. Transfer payments are not part of my national income, right? Very good. Okay. Now, next question that I've asked, GDP MP is equal to C plus I plus G plus NX. Okay. So, in this I have gross fixed capital formation, GFCF, plus I have change in inventory. Change in inventory. Okay, you need not worry. Closing stock minus opening stock, you don't know, it's okay. But it is change in inventory. That is also part of I, that much you remember. And also change in valuables, gold, etc. All that. Okay, so this is I. Investment into shares and all will not be part of my I. Not. So that's not part of GFCF. Then what does GFCF include? So GFCF includes many things. Okay, so investments made by government, investments made by private fellow, like machines purchased. Okay, so capital goods purchased. Okay, all that. Okay, and also individuals. We individuals also, you're buying new house, constructing a new house on the existing land. All that also will be part of my GFCF. Government building roads, infrastructure, all that. Now, one more important thing, what I want to tell you is something that is part of GFCF, which you may not think. Okay, addition of livestock. Now, this you may think it is not part, but yes, it is part. Addition of livestock, everything livestock, cows, buffaloes, addition of livestock. Okay, that also part of my gross fixed capital formation. So you can check if you want, wherever you're getting doubt, you can use the mobile. Okay, so livestock, is it part? Now, any major damage, okay, generally what repairs of assets, generally you don't take it as GFCF, but major damage, suppose there is a major damage and you are trying to repair the major damage, that is also part of GFCF. Okay, so my question to you all that I've asked you is basically if some foreigner is coming, he is buying some shirt, then where will it go? That was my question. It is part of X, that is export. This was the previous question that was already asked. Okay, now suppose, I think that is clear. Okay, then NDPFC is equal to compensation to employees plus mixed income plus operating surplus. This is income method. So in the production method, the question can be one what I've asked. Okay, so everybody should be knowing what is mixed income. Compensation to employee, this will include wages, salary in cash or kind. Okay, plus employers, not employee, employers' contribution to social security. Okay, so now one last question. So I think this should be clear. This is the concept which I've explained. I'm coming back. I'll ask you some more questions. Are you there? You're able to follow? So one more question I've asked you is, goods produced for own consumption, is it part of national income? Suppose a company is producing a machine, etc. That's part of national income calculation. That's something you have to remember. Investment into shares and all is not part of that investment I. Okay, so I includes GFCF plus change in inventory. Inventory is not a cap of, if you can say inventory, you can call it as a current asset. It is not a fixed asset. Okay, it keeps moving. It has to move out of the company within a span of 1 year. Okay, so change in inventory plus change in valuables. Okay, so that is GFCF. In GFCF, what can be asked, as we have seen. Okay, then another question to you all. Another question to you all is, old age pension given by government, etc., will it be taken as part of national income calculation? Okay. Old age pension given by the government. Old age pension given by the government, is it part of national income calculation? So you have to keep writing in the chat box. Okay, so yes, it is not part because it is a transfer payment. There should not be any problem. Okay, so it's not part of the national income calculation because it's a transfer payment. So there's no confusion there. That's a simple question. Okay, so then a restaurant, suppose a restaurant is using paneer to make kadai paneer. Is this paneer included? Restaurant is using paneer to make kadai paneer. The paneer which it has used, is it part of national income calculation? Got the question? Restaurant using paneer to make kadai paneer, only kadai paneer will be taken into consideration. Paneer will not be taken into consideration. Paneer is basically an intermediate good here. Okay, so that is what you should understand because it will lead to double counting, as simple as that. Okay, so if you calculate paneer and kadai paneer, it will lead to double counting. Is that clear? Okay, so now last question to you all. What is the difference between basic price and market price? Okay, so basic prices and market prices. We need to be fast. Difference between basic prices and market prices. Yes. GDP, see what is the difference between basic price and market price? Everybody knows factor cost, basic price, market price. Difference between basic price and market price. Please be fast. Okay. So when we calculate GVA and GDP, so one thing should be clear that GVA. No. Okay. See, when we are calculating GVA, so GVA is estimated at basic prices, right? And GDP is estimated at market price. This is the basic difference. Okay, so basic price is equal to factor cost plus net production taxes. So market price is equal to basic price plus net product taxes. Okay, so production tax means net production tax is what? Production taxes minus production subsidy. Okay, product tax, net product tax is what? Product taxes minus product subsidy. Okay, so in the basic price, what you don't have is the net product taxes. Now, suppose UPSC, there is a question, which of the following is a product tax? Okay, which of the following is a product tax? And suppose is giving some options. Okay, so you should be able to identify. So in the basic price calculation, we don't take the product taxes like the excise, GST, all these are product taxes. On product taxes are those which are levied on each product. Suppose excise duty is there. Excise duty is levied on production. If I produce 5 cars, I'm paying X amount of excise duty. If I'm producing 10 cars, then I pay 2X. That means on each product it is there. So, but when I talk about production taxes, they are independent of production volume, how much ever I may be producing, but the tax does not change. That is what is a production tax. For example, the tax on the land. Ratan Tata is paying some tax on the land. Okay, so this tax which he pays on the land is independent of how much ever cars is going to produce. So excise is a product tax, but the tax that is paid on land and things like that is a production tax. In the basic prices, you don't have these product taxes. You don't have the net product taxes. So in basic price, so market price has both. Market price is what? Basic price plus the net product taxes. I hope it is clear. Okay. Let's move forward. So this question, I think you should be knowing. There should not be any trouble in answering this question. Union Finance Minister on behalf of Prime Minister lays annual financial statement before both the houses of Parliament. What is the answer for this question? Everybody should be knowing this question. 20. So you can put the answer for this question. Simple polity-based question. This question. Yes. This one. Read the question. Yes. Okay. So B2 only, right? So on behalf of President, obviously. So this is wrong. First statement is wrong, everybody. And second statement is okay. At the union level, no demand for grant can be made except on the recommendation of President of India. Okay. Now, first of all, here with reference to Indian economy, consider the following statements. A share of household financial savings goes towards government borrowings. Dated securities issued at market rates in auctions form a large component of internal debt. Dated securities are those securities. Now, one question to you all. Can state governments issue dated securities? Okay, so if yes, please put it in the chat. Same question will not come. Can state governments issue dated securities? Yes, student. Can state governments issue dated securities? Yes, state governments can issue these long-term state developmental loans, can issue state developmental loans. If you're getting a doubt, then and there, use AI, use internet. So state developmental loans, these are long-term debt instruments that can be issued by state government, which are long, that is basically RBI can issue on behalf of the state government. These bonds, debt instruments. You can check that. But generally, RBI does not issue treasury bills on behalf of state government. RBI issues treasury bills only on behalf of the central government. But long-term securities or the dated securities are issued by RBI on behalf of both central government as well as state government. I think that should be clear for everybody. Is it okay? Yes. Is it clear? Okay. Keep your mobile phone ready or laptop ready. So wherever there is a point, you can immediately check and that should stay in your mind. Okay. The share of the household financial saving goes towards government borrowing. This is an easy question. Everybody should be answering. Dated securities issued at market related rates in auctions form a large component of internal debt. Obviously, you should know internal debt is more than the external debt. Okay. What is the answer for this question? Easy question only. I think everybody should be answering this question. Yes. Good. Okay. C. That's it. Okay. So share of household. Now what you'll use the mobile phone and tell me one more answer. Last 5 year household financial savings continuously increased. Is this statement right or wrong? Last 5 year household saving continuously increased. Is this statement right or wrong? You can check the mobile and tell me the answer. Last 5 years, household savings continuously increased. Is this statement right or wrong? Yes. Be fast. Yes, yes. No. Okay, fine. Last year, household financial save. That's the wrong statement. Good, good, good. Last year, people invested more into financial savings or physical savings? Financial savings or physical savings? Yeah. Answer. Waiting for your answer. Physical savings. Observe this, everybody. I want everybody to check. Everybody to check. Everybody to check. These are statements which are important. Physical assets. Good. Okay. Nice. So that is what I wanted. Okay, let's move forward. See, this is basically, you can see here, screen. Okay, so you can, I think you can see this, the basic structure, budget, general discussion, the budget in both the houses. Okay, so detailed discussion. Of course, you would have discussed this in polity, but I'm not going to dig much into this. But you should be knowing these things. And basically, major financial document that are required. And one more important thing is medium-term fiscal policy fiscal policy strategy statement. So this was already asked. Okay, so when we, you can see there where there are some underlinings which I have done here. Okay, so forget about the deficits. I'll come to the deficit later. Okay, so medium-term fiscal policy statement is pushed in based on FRBM Act, Fiscal Responsibility and Budget Management Act. Then we have this FRBM Review Committee, you should be knowing, NK Singh Committee 2016. And NK Singh Committee primarily talks about debt to GDP ratios of the government. NK Singh Committee says debt to GDP should be 60%, central government 40, states 20. Now, one question to you all. If I ask you this question, let's see whether you'll answer it or not. States debt to GDP ratio, is it in line with NK Singh Committee recommendations? States debt to GDP ratio, is it in line with encasing committee recommendations? And you have to be fast. States debt to GDP ratio, is it in line with encasing committee recommendations? I hope you're working on it. After 2 hours, let me know if you want a break. Okay. So state encase, it is not in line. Very good. Okay. Centers overall debt to GDP ratio, when you say general debt, that is both centers, state plus UT, it is more than 80%. You should be knowing that. So they're not in line with encasing committee recommendations. Okay, then escape clause. I think we should have heard of this word, escape clause. Escape clause was part of earlier FRBM document. Is it right or wrong? Escape clause. Escape clause is what? You can escape from reaching the FD targets, no? Okay, escape clause is part of earlier FRBM targets. Is the statement right or wrong? It is not part of earlier FRBM targets. Obviously, escape clause is part of encasing committee recommendations. Okay, so that should be clear. So medium-term fiscal policy statement also was pushed in because of FRBM only. Okay, now this is basically, we have the deficit trends here. So there are several trend-based questions that are asked in the exam. So trend-based questions, when we look at trend-based questions, you can see these are the targets. The FD, you have RD, revenue deficit, ERD, effective revenue deficit, that is the green one. And then you have the primary deficit. FD is nothing but borrowings. Now, one question to you all. The fixed deficit targets, these are fixed deficit. You can see 6.7, 6.4, 5.6, 4.8, 4.4. Okay, so last 5 years, FD is continuously dropping. Okay, so this was the COVID year. You can see 9.2. That is the COVID year. There should not be any confusion. This is COVID year. Okay. Now, one question to you all is, FD, fixed deficit, is a flow concept or a stock concept? FD is a flow concept or a stock concept? What happened? Is it difficult? What is a flow concept? Something that is measured over a period of time. What is a stock concept? Something that is measured at a certain point of time. For example, money supply. It's a stock concept. Okay, so if I ask you what is the cash in your pocket, something that is measured at a certain point of time. Okay, so FD is measured for one fiscal year. So something that is measured over a period of time. That means FD is a flow concept. But public debt is different from FD. Public debt is a stock concept. Today, if I'm asking what is the debt of government, maybe by tomorrow night, tomorrow morning, it may be different also. Why? Because government would have paid back its debt. So public debt is a stock concept. FD is a flow concept. I hope you're able to get this. Money supply is a stock concept. Total stock of money in the hands of public at a certain point of time. Okay, so these are the trends. Okay, so trends you should be knowing a little. Some trends you should be knowing a little. For example, if you see RD, revenue deficit. Revenue deficit is seen as the most dangerous form of deficit. Most dangerous form of deficit. So target of RD you can see 1.5% of GDP. ERD 0.3. FD target 4.4 and observe these trends. Observe trend. Last 5 years, what is the situation? Last 5 years, RD, what is the situation? So that becomes important. Okay. Now, so here you have the revenue budget. Okay, revenue budget, and we have the capital budget. Okay, so revenue budget deals with revenue receipts and revenue expenditure. Capital budget deals with capital receipts and capital expenditure. I hope everybody knows this. Capital receipts are those receipts which will either decrease asset or increase liability. Capital expenditure is that expenditure which will increase asset or decrease liability. Okay. Now, one question to you all is loans repaid. Where will it go? Loans repaid. You keep answering in the chat. Loans repaid, where revenue received, revenue expenditure, capital received, capital expenditure. So loans repaid, where will it go? So loans repaid is part of the capital expenditure. Okay. So one simple question here. So capital receipts, capital expenditure, revenue receipts, and revenue expenditure. So when we talk about capital receipts, asset decrease or liability increase. Okay. So government issuing market securities to raise money from the market. Government is issuing market securities to raise from the market like G-Secs. Where will that item go? Government is issuing market securities to raise money from the market. Where will that figure out in the chart? Government is issuing, RBI is issuing G-Secs or treasury bills and raising money from the market. Where will that go in this? Government is issuing, RBI is issuing G-Sec means government is borrowing. Government is borrowing means it's loans taken. Okay, so loans taken means it should be part of capital receipts, not capital expenditure. In the capital receipts, receipts are where that will be part of capital receipts. Okay, loans taken. Receipt is incoming money. Okay. Maximum rupee is coming from for the government. You can see this chart here. This is from the budget document only. Borrowings and other liabilities. And government is getting maximum revenue from income tax, 22%. You can see there. Income tax. After income tax, we have corporate tax. Income tax, we have corporate tax. I hope it is visible there. Okay. Maximum rupee goes to, observe this, expenditures. One important aspect which you should observe here. is after the state share of taxes and duties, which you can see here, you have this component, which is a dangerous component, which is the major component of the revenue expenditure. Major component of revenue expenditure. I hope it is clear. Are you there? Yes. Okay, you can see interest payments after the state's share of taxes and duties, it is the interest payments. Okay, so you can see, observe here, defense subsidies, centrally sponsored schemes, how much they are spending, central sector schemes, excluding capital on defense and subsidy. Okay, fine. So which of the following effects of creation of black money in India has been the main cause of worry to the government of India? This is a simple question. There should not be any trouble in answering this question. Anybody? See the question? Yes. What is the answer for this? Yes. That's a simple question. No confusion there. The answer for that is loss of revenue to the state exchequer due to tax evasion. Okay, so that is the answer for this question. There should not be any trouble there. Okay, so functions of RBI: money supply, money policy, forex management, and BOP. Okay. So here some concepts before we get into the discussion is, first of all, what is money supply? Total stock of money in the hands of public at a certain point of time. Okay, so money supply is basically a stock concept. Okay, and there are different types of money we should be knowing. One is RBI measures something like narrow money, broad money. Okay, so when I use the word broad money, it is indicated using M3. Okay, so M1, M2, M3, M4. Basically, these are broad, this is narrow. Okay, but in general parlance, most narrow, most liquid is M1. Least liquid is M4. Least liquid is M4. And most common measure of money supply is M3. Okay, so M1 is currency and coins in hand plus demand deposits in banking system. M2 is M1 plus post office savings. Okay, M3 is M1 plus term deposits with banks. Since you have the term deposit, it's not so liquid. Okay. M4 is equal to M3 plus total post office deposits. Okay. Money multiplier, you should be knowing. Money multiplier is equal to 1 by legal reserve ratio or M3 by M0. M0 is nothing but high powered money. High powered money or monetary base. Monetary base. Okay, so this you should be knowing. And total liability of RBI. Total liability of RBI is nothing but M0. Total liability of RBI is nothing but M0 or the monetary base. Okay, total liability of RBI is not M3 but M0. In M3 you don't have reserves. In M0 you have reserves also. So M0 is equal to currency in circulation. Okay, and you also have other deposits with RBI. Banks deposits with RBI. Okay, other deposits with RBI. So M0 is basically the total liability of RBI. The total liability of RBI is M0. Previously, there was a question. If you remove 1 lakh rupees from bank and if you have removed 1 lakh rupees from bank and holding it, what is the total change in money supply? Okay, there is no change in money supply. Why? Because M3 can be written as currency in circulation plus DD in banks, demand deposit. This is nothing but M1 only, plus the term deposits. Okay, I've removed money from DD and holding it in my CU, currency and coins in hand. Is there any change, total change in the short term? There is no change in M3 in the short term. The question was in the short term. So I'm removing money from DD and putting it and holding it in my hand, that is CU. In the short term, there is no change in my money supply. Okay, then there was a question, money multiplier will increase. Obviously, money supply in the economy will increase when the banking habit of the population is going to increase. Okay, so these were some questions which were already asked. Are you there? Yes. Okay, so you got these, right? So this is some background. Now, open market operation is nothing but buying and selling of GSEC. So here, few more things I will just mention because we don't have much time here. We need to be little fast. Okay, so when we talk about OMO, open market operation, so first of all, RBI uses different tools. This most of you know it, quantitative. Of course, this they will not ask straight, but what they can ask would be little different. So to handle money supply, RBI uses quantitative and qualitative tools. So in the quantitative, we have LAF. NBFCs cannot directly borrow in the LAF using LAF. This was a previous question. So you have repo and reverse repo. Then we have the MSF. Okay, we have OMO, open market operations, buying and selling of RBI, buying and selling of GSEC, right? And then as part of OMO, Operation Twist was used. So Operation Twist is what? Selling short term and buying long-term bonds simultaneously. What is the main purpose of Operation Twist? To reduce the yields of long-term bonds and make long-term loans cheaper. Make long-term loans cheaper. This was the objective. Okay. Then standing deposit facility. This is different from reverse repo. So what is the basic difference between standing deposit facility and reverse repo? Anybody? Anybody put it in the chat box. Difference between standing deposit facility and reverse repo. So collateral, that's true. So RBI basically, reverse repo, you know, the rate at which banks are parking their money with RBI. And RBI is going to push G6. Standing deposit facility is a mechanism where it is the rate at which banks are parking their money with RBI without RBI pledging GSEC. Without RBI pledging GSEC. No GSEC. That is what is SDF, Standing Deposit Facility. Another question to you all. Marginal standing facility, is it short term or long term? Marginal standing facility, short term or long term? Please put it immediately. Short term, overnight. Okay. Can other financial institutions also use MSF or only banks? Can other financial institutions use MSF or only banks use MSF? Only commercial banks use MSF. MSF is short term. G6, which are part of SLR, can be pledged under MSF, which can't be pledged under repo. Okay. So previous question was, can NBFCs participate in the liquidity adjustment facility? NBFCs cannot participate in LAF directly. They can't borrow from banks under LAF. Okay. But there are some NBFCs. That was a question already asked. There are some NBFCs which are called as primary dealers, which trade in G-Secs and all. So these NBFCs with certain conditions, they can participate, but not all in regular NBFCs. So all regular NBFCs cannot participate in LAF, Liquidity Adjustment Facility. But some NBFCs which are primary dealers, those entities which are trading in G-Sec, they can participate. I hope it is clear. Is that okay? Fine. So come back to this question. These are simple questions only. See, monetary policy can be tight. Tight monetary policy can be hawkish or dear money policy. Expansionary monetary policy can be dovish or cheap money policy. Okay. Or tight monetary policy can be called as contractionary also. Right? You should be knowing money supply will come down. So tight monetary policy of US Federal Reserve could lead to capital flight. I want you all to try this question and mark it. So see the first statement, tight monetary policy of US Federal Reserve could lead to capital flight. Yes, tight monetary policy in US basically will make dollar stronger and even the bond yields in US will increase. So the investors will move from India to US and buy US bonds. And therefore, there will be capital flight. And when there is a capital flight, our rupee value is going to depreciate because more dollars are moving out of India. So capital flight may increase the interest cost of firms with existing ECBs. So why capital? Because rupee value will depreciate, then my loan starts becoming costly. Okay, devaluation of domestic currency decreases the currency risk associated with ECB. What about this statement? What about the third statement? Anybody? Okay, so 1 and 2. Devaluation of domestic currency increases the currency risk associated with ECBs. Now, one question to all. When we talk about external commercial borrowings, ECB, okay, so who all can borrow under ECB? All corporate companies can borrow money. SIDB, Small Industries Development Bank of India, can borrow. Port Trust can borrow under ECB route. PORT, Port Trust, can also borrow under ECB route. And some portion of FCCB can also be part of ECB. I hope these things you should be knowing. Okay, so before we discuss REAR, NEAR, it is a difficult concept. It will take some time. We'll take some break. And is the speed okay? What are you able to follow, or is the revision happening? You just put it in the chat so that we will modulate it accordingly after the break. Yes. Okay. So let's start in 5 minutes. Okay, we'll start by 5:55. I think it should be okay for everybody. Yes, 5:55. We'll try to so that those concepts REAR, NEAR we will discuss, and we'll see how much you know, and then based on which we can increase the speed. Okay, that's all. Thank you. Take a break. Okay, so this was the question. So this is a little difficult concept, and of course, this is not part of money supply monetary policy. It is part of the exchange rate system. Okay, so to understand this, first of all, let's try to. Okay, so trade competitiveness of a country is decided by real exchange rate. Remember this. Trade competitiveness of a country is decided based on real exchange rate. Okay, so that is equal to nominal exchange rate multiplied by price of the product in the foreign nation divided by price of the product in India. So nothing but nominal exchange rate multiplied by, call it as P star by P. Okay, so this is basically, we are talking about RER, real exchange rate, or nominal exchange rate. Okay, so this is basically you're comparing two currencies only. But when we take NEER and REER, this is effective exchange rate. This is real effective. These are indices. So how is an indices built? You take a basket and put commodities or whatever it is. You assign weights to the basket, and the basket is indexed to a base year. And that base year is indexed to 100. So any index, whether it is CPI, it's an index. Sensex is also an index, sensitive index. Similarly, NEER, REER are also indices only. They are also indices. Okay. So how are they built? You're taking a basket. In this, we are putting major trading partners of India's currencies. So either it can be 6 basket or 40. and they are assigned weights. These currencies are assigned some weights. These weights are basically assigned based on how much trade we do with that particular country. The more trade we do with that particular country, more weight would be assigned in the basket. Okay, so now this basket is indexed to 100 because any index you are building, so the base year for these indices is 2015-16. Okay. Now what we should understand is here, what does this index measure? It measures how much of these basket of currencies are required to buy 1 Indian rupee. Again, I'm repeating, it is not how many rupees you require to buy this basket. It is the other way around. What is this other way around? It is about how much of these basket of currencies are required to buy 1 Indian rupee. That means whenever this index number is increasing, index number, suppose 100 is there, the index number has become 105. It means, what does it imply? It implies that I need more of these basket of currencies to buy 1 Indian rupee. I need more of these basket of currencies to buy 1 Indian rupee. Okay, so that means whenever, what does it mean? The near number, near index number, index means its index number will be there. Index number 100 is becoming 105. The near index number is increasing. It means I need more of these basket of currencies to buy rupees. So what does it imply? It implies that the rupee value has appreciated. Rupee is becoming stronger. That is what index number is increasing means rupee is becoming stronger and I need more of these basket of currencies to buy 1 Indian rupee. Same applies when it comes to REER. REER is also an index number. REER is nothing but near adjusted to inflation. But this is also an index number. And both these index numbers are increasing. It means I need more of these basket, more basket of these currencies to buy 1 Indian rupee. More basket of these currencies to buy. That means rupee is appreciating, or when rupee appreciates, India will become less trade competitive. India will become less trade competitive. Okay, I hope everybody's understood this. Is there any doubt? Yes. So both these index numbers are increasing, whether it is REER or whether it is NEER. It means rupee is appreciating and India is becoming less trade competitive. That is what is understanding. Okay. So now let's go to the question. See, an increase in NEER indicates appreciation of rupee. Yes, NEER index number is increasing. It means more of these basket of currencies I need to buy 1 Indian rupee. That means, yes, rupee value is appreciating. An increase in REER number indicates an improvement in trade com. No, an increase in REER also indicates that rupee is appreciating. Rupee is appreciating means India is going to become less trade competitive. I hope it is clear. So that means the second statement is wrong. Okay. Third statement you can see, an increasing trend in domestic inflation relative to inflation in other countries is likely to cause an increasing divergence. See, NEER is adjusted to inflation. REER is adjusted to inflation. NEER is not adjusted to inflation. So when the domestic inflation is increasing, that means there will be a higher divergence or gap between REER and NEER. So therefore, I think now you should be able to mark the answer. always remember, trade competitiveness of a country is decided based on real exchange rates. It is not based on nominal exchange rate. Trade competitiveness of a country. Yes, answer is 1 and 3. Fine. Let's go to the next question here. This is simple only. If inflation is too high, RBI is likely to buy G-Secs. Come on, now this should be easy. So try this question and mark the answer. See this question, everybody. See, basically, inflation is too high. Then RBI should focus on reducing the money supply. So if you have to reduce money supply, then you have to, RBI has to sell G-Sec and squeeze money from the market. As simple as that. So what is the answer for this question? Yes, what is the answer? So here, answer should be 2 and 3. First statement is wrong. Wherever 1 is there, that's a wrong statement, obviously. If the rupee is rapidly depreciating, RBI is likely to sell dollars, obviously. You're selling dollars. Okay, so selling dollars in the market. Okay, so sell dollar so that dollar supply will increase and dollar will become less costly and rupee value will appreciate. If interest rates in US or European Union were to fall, obviously loans are cheaper, you'll get more dollars, obviously. And you'll also get you'll borrow from outside. So therefore, third statement is also okay. Now, next question is also simple. Please try this question. Think properly and mark the answer. See, if devaluation is done, what about the first statement? Improves the competitiveness of the domestic exports in the foreign market. That's true, because our exports will become cheaper. Increase the foreign value of domestic currency. What about the second statement? What is the answer for this question? Yes. Everybody. So improves the trade balance cannot be commented because trade balance is about import and export. So we can't comment on the trade balance. Okay, so we'll see the external sector slides at a faster pace. We'll do this and then I'll show you the slides. Okay, trade balance cannot be commented. Increases the foreign value, no, it decreases the foreign value of domestic currency. Okay, so therefore answer should be 1 only. This was the question that I've asked you, money multiplier M3 by M0. Okay, so money multiplier in an economy increases with which of the following? So obviously more people should go and push the money in the deposits. So money multiplier in economy increases with the increase in the banking habit of the population. This is a simple question. Already I've discussed this. Now try this question, demand pull inflation. So everybody should be knowing demand pull inflation is too much of money chasing too few goods. Cost push inflation is basically because of supply constraints or raw material costs increasing, oil costs, etc. That is cost push inflation. So in India, inflation targeting, the target of 4% is fixed by RBI. The target is fixed by government in consultation with RBI. That 4% target is fixed by whom? It is fixed by government every 5 years in consultation with RBI. And the Monetary Policy Committee comes up with the repos to keep the inflation target within that prescribed limit. So say 4 plus or minus 2 or 2 to 6%. And currently we are targeting 4 and we are below 4% right now. We are happy. Okay, so with reference to Indian economy, demand pull inflation can be cost increased by which of the following? Can be cost. Simple. C5, rising interest rate should be removed from the option. Observe, he has given the answer state. Rising interest rate will reduce money supply. So demand pull inflation will reduce. So therefore, if I remove 5 from the options, so I should be able to get the answer for this question. 1, 2, and 4. I think everybody is able to do that. That's a simple question because answer is given in the clue itself. There is this clue clearly mentioned. Now this question already I've discussed. So we've discussed currency in circulation, currency and coins in hand, plus demand deposits with the banks, plus time deposits with the banks. That is what is M3. So aggregate money supply in the economy, let's say, I'm putting M3 here, M3. So currency and coins in hand, plus DD with banks, plus TD with banks. Suppose if I'm taking 1 lakh in cash from the DD and holding it here, my overall M3 does not change. This is what we have discussed, M1, M2, M3. Okay, and M3 is called as broad money. M1 is the narrow money. So most liquid is M1. M1 is most liquid. And M3 is the largest component. M4 is largest, of course, but common measure of money supply is M3. But total liabilities of RBI is not M3. Total liability of RBI is M0, which is the high-powered money. Now, this is a simple question asked in 2019. In the context of India, which of the following factors are the contributors to reducing the risk of currency? Easy question. Answer this question, everybody. See the question on the screen. Yes. What is the answer for this question? Obviously, second statement is wrong. You can see that. In the context of India, which of the following are contributors to reducing the risk of currency crisis? Yes. What is the answer? Please put it in the chat. Yes. 1 and 3. Remittances from Indians abroad, foreign currency earnings. The dollars are coming in. One more question here, simple question here. Very simple question. RBI decides to adopt an expansionist monetary policy. Which of the following would it not do? So expansionist it is adopting. That means money supply should increase. So doing these, now see here, RBI decides to adopt expansionary monetary policy. Which of the following it will not do? It will do this, cut the bank rate and repo rate. Increase the marginal standing facility, it will not do this. Cut and optimize SLR, will do this. Okay. So what is the answer for this question? And also tell me, how is bank rate different from repo? In the chat. Answer for this question and also tell me, how is bank rate different from repo? Yes. So if we cut the bank rate and repo rate, it will increase money supply. It's expansionary. So it will do this. Question is, which of the following would it not do? Second one, it will not do. Cut and optimize SLR, it will do. So two only. What is the difference between bank rate and repo? Difference between bank rate and repo? See, bank rate is long term without GSEC. Very good. Repo rate is short term. Okay, fine. What are term repos? Anybody? Very fast. Term repos. Okay, so somebody tell me, what are variable repo rates? Variable repos in news? Variable repos. So it is in news, so you can use your mobile. Variable repo. How is the variable repo? See, variable repo, my question to you all is, variable repo rate will be higher or lower than repo rate? That is what you'll put it in the chat, and you have to be fast. Variable repo rate will be higher or lower than repo rate? Yes. Yes. See, variable repos are basically, if you say the repo rate is 6%, variable repo, and still the banks are not borrowing from RBI. That is when variable repo rate is helpful for RBI. Variable repo rate is decided through auctions at the banking level. Variable repo rates are lower than the repo. Variable repo rates are lower than the repo, but higher than the reverse repo. Variable repo rates are lower than the repo, but higher than the reverse repo. How is that variable repo rate decided? And generally using variable repo, they'll not borrow for 1 day. Repo is 1 day. It's generally more than 1 day or 1 to 14 days. Basically term repos. Okay, and the variable repo rates are lower than the repo rate, and it gets decided based on the auction at the banking level. Auctions. Okay, it is not the same 6% or 6.5, 6, which is decided by RBI or the MPC. Okay, so it will be lower than the repo. Yes. Good. Let's move forward. Okay, so before we talk about the banking system, I will tell you a few things which are in news, and I expect you all to go back and refer them as they are in news. Okay, so one important aspect that is there for discussion in the banks is the priority sector lending. So the priority sector lending targets, there are few new things that have come up. One is for the urban cooperative banks. So the PSL target has been increased to 60%, and it will be touching 75 recent. That is by the next year. Second is, you should be knowing for RRBs, priority sector lending is target is 75, and small finance banks also it is 75. All Indian banks and foreign banks with 20 branches minimum, the PSL target is 40%. Okay, so I think there is no confusion there, and that should be clear. Okay, and then there is also a weighted district program that they have come up with. Okay, so that is basically when we talk about so that is so government they have come up with the revised priority sector lending targets. Revised priority sector lending in the sense like so those districts with lower credit flow. Okay, so they will be given a higher weightage, that is 125% weightage. What does that mean? Banks have to give more PSL loans to those districts with lower credit. Okay, so lower credit is something like a loan availability is less than 9,000 rupees per person. And those districts where there is a higher loan availability, around more than 42,000 per person, then PSL would be lower. PSL would be lower. That is weighted approach with respect to districts. This classification has come up recently. And then priority sector lending certificates in news. So I think you should be knowing about priority sector lending certificates. So priority sector lending certificates are basically, suppose there is a bank which has crossed 40% target of the PSL. Okay, so you should be knowing that they can sell the priority sector lending certificates to those banks which have not achieved the target. This is one. Okay, so with respect to PSL targets in agriculture not reaching, you will put the money in RIDF, Rural Infrastructure Development Fund, and this is under NABARD. Now, one question to you all, there is also Urban Infrastructure Development Fund in news. Which All India financial institution handles this Urban Infrastructure Development Fund is something which you will tell me now. Right away. Right away, you have to tell me Urban Infrastructure Development Fund. Is that okay? We need to be fast, otherwise we will not be able to discuss current. Urban Infrastructure Development Fund, which All India financial institution is handling it? It is National Housing Bank. Okay, there are 5 All India financial institutions you should be knowing. You have the SIDBI, you have NABARD, you have Exim Bank, you have NABFID, and you have National Housing Bank. NABARD does not give direct loans to individuals. SIDBI gives direct loans. NABARD does not give direct loans to individuals. Institutions, it is different. Okay, yeah. Urban infrastructure is under National Housing Bank. So you have to dig deeper. Now, in news, again, is RBI's surplus transfer. Why? Because last year, the transfer which RBI has paid to the center is one of the highest. So you should be knowing about RBI's surplus transfer. You should know that RBI is one such non-profit making institution which earns a lot of profit and it does not pay any income tax. RBI does not pay any income tax because it's a non-profit. See, you should know the assets and liabilities of RBI. So what are the things that are part of the asset side of RBI? What are the things that are part of the liability side of RBI? So for example, when we talk about the GSECs or the gold or the bonds issued by RBI, okay. So all these are assets, and on the liability side of RBI, all currency issued by RBI, all vault cash in the banks, okay, or banks deposits with RBI. All these are what liabilities of RBI. So you should know, one is, since RBI surplus transfer is in news, you should know the assets and liabilities of RBI and should know how RBI earns income, how RBI earns expenditure. There is also this contingency fund in RBI. So maximum contingency fund transfer was done in the recent past because RBI has surplus cash with it. Okay, so these are the things that are in news related to the banking system. And there is also this credit to deposit ratio. So there is a very high credit to deposit ratio that was seen. And this has brought in a credit from the deposit, the credit is going more than credit to deposit ratio was more than 78%. That is one of the highest since 2005. And this high credit to deposit ratio means banks do not have cash in their pocket, and that is not good. Okay, so several mechanisms have been brought in to reduce the or increase the liquidity in the hands of banks. Okay, so one way is the CRR was reduced, forex swaps, which I was talking about. All this was also part of that. I hope you're able to follow. Another important area in news which you should be reading is obviously small finance banks. We can't discuss everything, but see, it is in news means you have to read small finance banks. So the government has come up with criteria, that is RBI has come up with criteria for small finance banks to become universal banks. How can small finance banks become universal bank? Okay, so that means they should have a minimum net worth of 1,000 crores. There are certain criteria. Okay, they should have profits in the last 2 financial years. Okay, their gross NPA should be less than 3%. Like this, there are some criteria which RBI has come up with. Okay, so that is important. Okay, and then something that is in news is the urban cooperative banks. Urban cooperative banks, the PSL requirement up to 60%. Okay, that is updated now. Okay, are you able to follow? I have to be fast, so I'm just thinking these are current affairs. Are you able to? Are you there? Are you able to follow everybody? These are the things that are there in news. Yes, yes. Okay. So before we discuss few more current areas related to the bank. Okay. So first solve this question. This is a simple question only. With reference to rules imposed by RBI while treating foreign banks, consider the following statements. There is no minimum capital requirement for wholly owned banking subsidiaries. That is wrong. There is a capital requirement for everything. So around 500 crores. Okay, so that's a wrong statement. For wholly owned banking subsidiaries in India, at least 50% of the board members should be Indian. Okay, that's okay. So this is a factual question. Okay. See, there is also discussion of categorization of urban cooperative banks. You have tier 1, tier 2, tier 3, tier 4 categorization of urban cooperative banks. Okay. Yes. Okay. So you'll also read about perpetual bonds or additional tier 1 bonds. See, perpetual bonds are there in news, or these additional tier 1 bonds. See, perpetual bonds are those bonds which do not have any maturity period. Till perpetuity, you will get interest. That does not mean they are risk-free. They are very high-risk bonds, because RBI can call back these bonds if the bank is not doing well, and you can't ask for interest. So there is a very high risk in these perpetual bonds or the additional tier 1 bonds. So this 81 bonds is in news. So you should be knowing something about the 81 bonds. 81 bonds are also perpetual bonds. The meaning of perpetual bond is those bonds which are till perpetuity. There's no maturity period whatsoever. Okay. So let's go to the next question. Syndicated lending spreads the risk of borrower default across multiple lenders. So I want, because it's a very recent question, so I want you all to answer this question. Yes. What is the answer for this question? Okay. Syndicated lending spreads the risk of borrower default across. Yes. So the whole logic of syndicate lending, group of entities are giving the loan because the risk is spread across multiple lenders. That is true. Okay. And syndicated loan can be a lump sum amount, or it can be, you need not take everything at one go. It need not be lump sum. It can be a credit line also. So this is a wrong statement. Okay. Next, let's go to the next question here. Self-help group program was originally initiated by State Bank of India by providing micro credit to financially deprived. In a self-help group, all members of a group take responsibility for the loan that an individual member takes. This is a right statement. So if there is a default also, it is not on the individual member, it is on the responsibility of the self-help group only. Self-help group program was originally initiated by State Bank. Is this statement right or wrong? Students, what is the answer for this question? What about the first statement? Self-help group program was originally initiated by. So what is the answer if it is not SBI? NABARD. Okay, good. What about the third statement? RRBs and scheduled commercial banks support self-help groups. Is the statement okay? Third statement. Yes. Yes. Good. Okay, so that's a simple question. Of course, since it's a previous question, there should not be any confusion. We would have solved it already. Now, for handling, with respect to banking, you should be knowing prompt corrective action. So one thing which you should be knowing PCA, because primary urban cooperative banks were pushed, or there was a framework that was given, PCA framework, prompt corrective action. Okay, so this prompt corrective action. So you should be knowing what is a prompt corrective. Banks are not doing well with respect to certain aspects. Okay, so prompt corrective action. So especially one is the profitability of the bank, whether the bank is generating returns on assets, and then capital adequacy ratios and NPAs. Capital adequacy ratio, NPA, and profitability or return on assets. These are the criterias which you take whether the bank is doing well, not doing well, or whether we have to put it in the PCA list. Okay, next question. Simple question. I hope everybody will be able to answer this question. This question, everybody. Governor is appointed by central government. Certain provisions in the constitution give central government the right to issue. So no provision in the constitution here. Okay, the second statement, if you know the answer. Second statement is wrong. Okay, and the governor of RBI draws his power from RBI Act. That is true. Okay, so let's go to the next question. So they are supervised and regulated by not the local boards, even RBI is there. Supervision and regulation, both are different here. Okay, so 2019, these urban cooperative banks, now they have brought in under the purview of Reserve Bank, RBI. Okay, so what should be the answer for this question? Yes, go ahead, mark the answer. Yes, 2 and 3. See, this question could have been answered if you would have solved the previous UPSC question. So previous UPSC question was, of course, which of the following banks give maximum loan to agriculture? And they gave options. The options that were given were RRB, microfinance, scheduled commercial banks, and cooperative banks. An answer for that question is, who gives maximum loan to agriculture is commercial banks. It is not RRB. It is not cooperative banks. It is not microfinance institutions. So this was the previous question. And if you would have solved that previous question, then this question answer should be simple. So what is the answer for this question? Yes. Okay, I'll show you the question again. This one. Based on that logic, what about the first statement? Is it right or wrong? Answer. First statement is wrong. Yes. What about the second statement? You should be able to guess the second statement without any trouble. Second statement. Correct. Okay, fine. So that is how, see, previous questions when we solve, that will definitely help us. There is a clue in the question. Use the clue and mark the answer. Use the clue. You'll tell me what is the clue. Yes. D is right or wrong? 3 is a wrong statement, so it's not CAG. So once you remove 3, you get the answer. So UPSC, this 2019 paper was more simple. This question is about the functions of RBI. Lender of last resort. Refers to which of the following? Answer. Everybody should be able to answer this. Again, putting it. Yes. Good. Good. So lender of last resort, providing liquidity to the banks having a temporary crisis. Okay. See, capital market, money market, FDI. See, news, one thing you have to read. Since we can't discuss everything, I'll mention, you keep writing and go back and see. One is capital gains tax and real estate. It was in news for the last 1-2 years. Another question to you all, is capital gains included in part of national income calculation? Is capital gains part of national income calculation or not? You have to be fast. I can't ask you everything. We can't discuss everything. We have another 1 hour, 15 minutes. So is capital gains part of national income calculation? Yes or no? You put it in the chat and you need to be fast. And the topic that you have to read, one is read about inheritance tax. So are there countries where inheritance tax is there? South Korea, US, India, we don't have inheritance tax. That was in news. Okay, so you should be reading about that. Now, then capital gains tax with respect to real estate. Last year, there was a lot of issue. Okay, especially with respect to that long-term capital gains tax. Okay, so that has to be read. And then base erosion, profit shifting, and double taxation avoidance agreements in news. Okay, so DTA was in news. Okay, and there was also discussion on windfall tax. Windfall, I think everybody should be knowing what is a windfall tax. That was in news. Anybody, what is this windfall tax? Put it in the chat. Yeah, windfall tax. Put it in the chat. Unexpected high profit earned. Very good. Okay, so government has reduced windfall tax on domestically produced crude oil. Very good. Okay. Industries with more profit, not because of talent, because of some situation. On such industries, you're coming up with windfall tax. Okay, so good. Okay. So I'll just put a framework before we start financial market topic. And simple questions, and a lot of questions are asked in these money market and capital markets. Okay. So you keep noting or listening to. So when we talk about financial markets, we have two types, two financial markets. One is we have the money market, and another one is the capital market. Okay, some basic understanding of money market. See, money market, one, it is short term. And the debt instruments in money market are maturity period would be less than 1 year. Transactions happen in bulk. money market also has a secondary market. And money market is regulated by RBI. These are a few basic things. Okay, money markets are regulated by RBI. Money market, who are the participants in money market? We have the banks, RBI, and we have other instruments in the money market. So these other instruments in the money market, we have government related instruments. So when it comes to government related instruments, we have treasury bills, cash management bills. So treasury bills, today we have 91-day, 182-day, and 364-day treasury bills. If you want to borrow, if government wants to borrow for a period of less than 91 days, RBI issues cash management bills on behalf of the government, central government. So basically T-bills and cash management bills are almost the same, except that if government wants to borrow. Okay, and then all this is money market only, we're writing money market. Okay, so then we have the private entities, we have the certificate of deposits, banks, we have commercial paper and commercial bills. All these are part of the organized money market. Organized money market are regulated by RBI. Similarly, we have unorganized money market. Of course, we also have the call money market, interbank borrowing for a period of 1 day. Okay, and even last year question, CBLO, collateral borrowing lending, it is a money market instrument. Short term, but collaterals. Okay, call money market, all these are money market. So these are all organized. Unorganized money market is also there. Unorganized money market, we have instruments like hundi, already asked. Hundi is like the commercial bill, but hundis are not accepted by RBI. This is unorganized. Okay. Now, when we look at these money market instruments, they are basically generally discounted securities. Discounted security. Issued at discounted rate and purchased at the original face value. They do not have regular interests announced, or they are non-coupon. When we talk about treasury bills or cash management bills, these are non-coupon bonds, non-coupon, no coupon announced, or we call them as zero coupon bonds. These things you should be knowing. These are non-coupon, they are discounted securities. Okay, so capital market, long term, we have debt instruments also. We have GSECs, debentures, bonds, and we have equity also. Okay, equity also, and we have shares. In that we have equity shares and preferential shareholders. Preferential shareholders. Okay, and then we have mutual funds. We have derivatives. So last year question was, which of the following is a financial instrument? And that's swaps. So derivatives, you have options, forwards, futures, and we have swaps. Capital market is regulated by SEBI. Money market is regulated by RBI. This is a brief differentiation between money market and capital market. I hope it is clear. shuffling. Okay. So okay, now come back to this topic. See the question now. You can tell me the answer for this. This was already asked. Collateral borrowing and lending obligation. This was basically a money market instrument. Collateral is there, but it is only for a short term. This was the previous question. Hundi was also asked long back. Okay. Then this was a question which we have discussed today already. See, FIs can also, what is the answer for this question? You try and put it in the chat box. We already discussed this while discussing the concept. Yes. So NBFCs, put the answer in the chat box. Okay. Can NBFCs borrow under LAF? NBFCs, can they borrow? No. NBFCs cannot access LAF. Regular NBFCs can't. So that first statement is wrong. See, if you go to RBI's website, open who can access LAF later, you will see there are certain primary dealers. Primary dealers can be banks also, Kotak Securities also. So those NBFCs, with those primary dealers which are operating as NBFC, they can borrow, but not the NBFCs, regular NBFCs. So NBFCs cannot access LAF. First statement is wrong. FIs can hold GSEC. Yes, FIs can hold GSEC. Stock exchanges can offer separate trading platform. See, the money market, stock exchanges can offer separate trading platform for debts. True. Okay. Money market also has a secondary market which is provided by DFHI. DFHI is Discount Finance House of India, which is handled by SBI. You call it as SBI DFHI. Simple question. Capital markets. See, call money market, treasury bill, money market. 2 and 3 are wrong. Bond market, debentures, these are all debt market. These are all capital market. 1 is capital market, 4 is also capital market. So 2 are right. Second one is money market. Third one, treasury bill market, is also money market. I hope it is clear, everybody. Is that okay? See this is a very interesting question. This is about bonds, which we call it as inflation index bonds. So inflation index bonds are indexed to inflation. Suppose they are paying, let's say, WPI plus 1.5. That means they're indexed to inflation. If WPI increases, the interest you get will also increase. So your interest as well as principal are both indexed to inflation. That is a benefit. So if something is indexed to inflation, then initially when they are issuing these bonds, they will offer lower coupon also you will buy, because they are hedged against inflation. Since they are hedged against inflation, though they offer lower coupon also, you will be able to buy. Okay, now try this question. Yes, answer for that question. Again, I'm putting it, everybody should try. The government can reduce the coupon rates on its borrowings by way of inflation index bond. Since they are indexed to inflation, offer less coupon also, you will be ready to buy. RBI when it is issuing IIB. So that statement is okay. IIBs provide protection to investors from uncertainty. That is what it is. That is, so bond holder inflation goes against bond holders. Previous question 2012. So IIBs don't go against bond holder. Why? Because it is providing a protection. True. Third statement is wrong. Interest received as well as capital gains are non-taxable. No, both are taxed. They are like every other bond where interest as well as capital gains are taxable. Same logic applies. Now you try this question. Same logic, the logic which we have discussed should be used for marking this question. Yes. This one. Yes. Try this question, which is visible on the slide, visible on the screen now. So tell me the answer for this question. Convertible bond. Same logic. See here, as there is an option to convert, exchange the bond for equity. So therefore, risk is less. Risk of inflation is less because they can be converted into equity. And therefore, convertible bonds pay a lower rate of interest. True. They will buy in spite of paying lower rate of interest because you can convert it. Okay, so therefore that is okay. The option to convert to equity affords the bondholder a degree of indexation for rising consumer prices. Yes, that's the reason. Both the statements are okay. This we have already discussed. Which are the factors that will affect the bond yields? All the three factors: inflation, RBI policies, and the actions of the Federal Bank, Federal Reserve. Use the clue to eliminate and mark the answers. Try this question, everybody. This one which is visible. Use some clue, use some logic. Yes, what is the answer? Answer for this question. I'm again showing it. Try. Yes, CDSL is jointly promoted by RBI, will not be there here. Okay, so when you're talking about CDSL, NSDL, CDSL are the two depositories which we have, where our shares will be stored in the physical format there. Okay, so retail investors through demat accounts can invest in treasury bills and yes, and Government of India debt bonds in the primary market. Yes, that's true. We can buy T-bills using Zerodha. You can open and buy. Negotiated dealing system order matching is a government security trading platform of the RBI. Yes. So that's basically an electronic trading platform operated by RBI for buying and selling G-Secs. Now, try this question simple based on our discussion, the first discussion which we did, where I've explained about the different instruments. You should be able to mark this answer. See, certificate of deposit, it's a short term. It can't be long term money market. So second statement is wrong, obviously. Call money, short term, finance use per interbank, yes. 1 day call, notice money is 1 to 14, short term money. Zero coupon bonds are interest bearing short term bonds. They are non-interest bearing. There's no coupon announced. They're non-interest bearing. So T-bills are also zero coupon or non-coupon. They don't offer regular interest. They are discounted securities issued at discounted rates and purchased at original face value. So what is the answer for this question? Everybody should be able to answer this. Getting different answers here. Third statement is okay. First statement is okay. Okay. So this is the answer. Second statement is wrong. Fourth statement is also wrong. See, in industries right now, what has to be read? One is coal. Okay. Two, technical textiles in news. IIP index, index of industrial production. Again, in IIP, you have index of 8 core industries. Index of 8 core industries constitutes around 40% of our IIP index. In that index of 8 core industries, we have which one has maximum weightage? I'm asking you again this question. You try and tell me the answer, put it in the chat. The question is, in the index of 8 core industries, which we have, this is a previous question, index of 8 core industries, which entity has maximum weightage? Yes. In the index of 8 core industries, which entity has maximum weightage? Check and write. Index of 8 core industries. You should also, once there was a question on what are the 8 core industries. It is the refinery products. It's not coal, it is refinery, followed by electricity. UPSC previous question, go back and check. Refinery was not given. and electricity was given. And after refinery, it is electricity. And therefore, you should mark electricity as answer in the previous question. Okay, so that was how the question was asked. Okay, so factual question, of course. Come back here. CSR rules specify that expenditures that benefit the company directly or its employees will not be considered as CSR activity. True. So not for, it is like it mentions it's not for employees, company directly or employees. Okay, it's not for that. CSR rules do not, there is a minimum spending obviously on CSR Act, 2%. Okay, so companies to spend at least 2% of their average net profits made during 3 immediately preceding financial years. Made during the 3 immediately preceding financial years. Okay. Now, what is the purpose of first of all, now first question is, when we talk about infrastructure investment trust, who regulates InvITs? You tell me first. First, tell me who regulates InvITs. Put the answer in the chat box. Who regulates InvITs? Who regulates infrastructure investment trusts? SEBI. REITs and InvITs, real estate investment trusts and infrastructure investment trusts, are regulated by SEBI. I hope everybody knows this. Okay. And what do they do? What does REIT do? It pulls up funds from the market and invests into commercial real estate. And as and when the commercial real estate performs and generates some output, you can also get some return on the units which you have got. Like the mutual fund, you're buying units. Okay, so and the return you get, whether it is interest income or the dividend income, is taxed by the government. InvITs, see, what we should know is 3 policies of the government with respect to infrastructure funding. One is the National Infrastructure Pipeline. 111 lakh crores government spend. We said we will spend between 2020 to 2025. And we will focus on 9,000 projects. That is National Infrastructure Pipeline. Then government came up with monetization pipeline. In that 111 lakh crore, government was saying 6 lakh crores we will raise through monetization pipeline. That means existing ports, airports of the government would be monetized, will be given on lease. And that's how you generate the return. That is leasing. And then the government came up with national logistics policy. The whole logic of logistics policy is to reduce our logistic cost to 8% of GDP by 2030. 8% of GDP by 2030. Now it is around 14 to 18%. Logistics Performance Index is an index given by World Bank. We also came up with a similar kind of index, which is our own version of Logistic Performance Index, which is the Leads Index. Then the 4th entity is the PM Gati Shakti. So these are the 4 things. PM Gati Shakti is a scheme of good governance. All the government departments and ministries should sit together, discuss, and then implement. Okay, so that is okay. So now to raise money for infrastructure, several things have been done in the recent past. Government came up with allowing 100% FDI into infrastructure, SEZs, infrastructure debt fund companies. viability gap funding from 2006 onwards. Viability gap, that is the central government. The finance ministry puts up to 40% of the funds capital cost of the PPP. That is what is viability gap funding, or we call it as the VGF funding. Okay. And then reset now these four things which we have talked about, that is the national infrastructure pipeline, monetization, logistics, and PM Gati Shakti. And there was also a focus on InvITs. So using InvITs, there is public sector InvITs. That is basically this is basically for building national highways. So the money you raise through InvITs, you wanted to build national highways. Okay. So this is the brief background of infrastructure related aspects. So here the question, interest income from deposits in infrastructure, interest income from InvITs distributed to their investors exempted from tax but dividends. No, both are taxed basically. This was done in the before last year budget where the interest and dividends are taxed. So this is wrong. InvITs are recognized as borrowers under SARFAESI Act. Yes. InvITs are recognized as borrowers under the SARFAESI Act of 2002. Now this is simple and I want you all to answer this question. The question which you see. The question which you see on the slide here, try answering this question. With respect to expenditure made by an organization or a company, which of the following statements is correct? Yes. Yes. Acquiring new technology is capital expenditure. True. See, debt financing is considered capital. Equity financing, no. Both are basically capital expenditures only, whether it is debt financing or equity financing. So this is a factual question, completely factual. Okay, so in India, what is the role of Coal Controllers Organization? So CCO is a major source of coal statistics in Government of India. True. It monitors progress of development of captive coal lignite blocks. Yes. It hears any objection to the government's notification relating to acquisition of coal-bearing areas. All the three statements are right. It ensures that the coal mining companies deliver the coal to end users in the prescribed time. So this is the wrong statement here. It is no way concerned with coal mining companies delivering the coal to the end users. This question I will explain first. And then, see, this is about interest coverage ratio of a firm. So who will check this interest coverage ratio? See, generally, banks check this ratio. We can also check this ratio before making any investments into a particular company. Okay, so why? So what does this interest coverage ratio does is, it basically checks the earnings of the company, how much earnings the company has to cover the interest payments. Okay, so generally there is something called as debt to equity ratio. There are certain companies who have high debt to equity ratio. For example, Airtel. But that doesn't mean Airtel is a bad company because you have to come up with new towers, etc. So they have high debt to equity ratio. Okay, so for such companies which have high debt to equity ratio, still the company can be good provided they have high interest coverage ratio. So interest coverage ratio measures the earnings before interest and tax of the company to the interest payments to be made. Suppose the earnings are 100 rupees and the interest payments to be made is 50. That means the company using its earnings can cover its interest payments 2 times. Minimum 2 is better. For suppose there is a company where 100 rupees is the earnings before interest and tax, but the interest payments to be made is only 10 only. That means using its earnings, the company can cover interest payments 10 times. 10 times. So this company with higher interest coverage ratio is more stable. That means it can cover its interest payments 10 times with its earnings. Okay. So this is some background with respect to interest coverage ratio. And now you can go to this question. Yes. Yes. It helps in understanding the present risk of a firm that a bank is going to give loan to. True. It helps in evaluating the emerging risk of the firm that a bank is going to give. Yes. Emerging risk also, because whether the bank will whether the firm will get into debt trap or not can be checked. Higher a borrowing firm's level of interest coverage ratio, the worse is its ability. Bro, it is wrong. See, higher 10 times, it is better. Higher the borrowing firm's level of interest coverage ratio, the better actually. 10 times it is better. 2 is minimum required. 10 is good. So higher. So the third statement here is a wrong statement. I hope everybody is able to get this. Everybody has understood this interest coverage ratio. So with respect to banking, there are other ratios also. One is there is something like the slippage ratio. Slippage ratio talks about at what rate the new loans are turning out to become bad. Okay. Then provisioning coverage ratio. Anybody, what is this provisioning coverage ratio? How much is the ideal provisioning coverage ratio required? Yes. How much is the ideal provisioning coverage ratio that is required? See, ideal provisioning coverage ratio is 70%. So how much the banks have provisioned to the total gross NPAs? That is what is provisioning coverage ratio. And the ideal provisioning coverage ratio is 70%. Now this question, some data is important. I'll show you the data. So see this question, everybody. Try marking the answer for this question. See, this number is too much. Huh? Many local companies and some small foreign companies operating in India have taken advantage of India's production-linked incentive scheme. That's true. So the first statement is wrong. See, 32% of global export. That's too much. So this is important. So this is important. If you make an observation, this can be asked last 10 years. So our export growth you can see here. So this is India's export reach historic highs. This is the article. Okay, so in this, you will find India's export growth over the years. Okay, so let's say 10-year period. India's merchandise exports increased by 39% only. But agriculture export growth was more than 100% in the last 10 years. You can see this data here. You compare these two. Agriculture export growth 112%. Merchandise export 39%. See the service sector exports growth. Service sector exports growth. Observe these. These are important. Agriculture export growth is more than 100. Merchandise export, you can see it's less than 50. Goods service export is more than 100. These are the things which we have to. 5 regions for India's exports. Top 5 regions. You can see here. I think you're able to see this. US, European Union. Okay. Then you can see here India's top merchandise export destinations. US, followed by UAE, then Netherlands, and then China. Observe them. India's top merchandise export destinations. I think it is visible. You're able to see. These are important. These are important. All these are important. Okay, so because they can ask India's agriculture exports increased more than 50%, let's say. So it's more than 100, in fact, and it's a very decent increase. Okay. Fine. See, we can't stop by 8 o'clock. I think there are some other documents also which I wanted to show. I'll extend a little. Is that okay with you? Just wanted to ask you first. Okay, so I wanted to show some more. We'll take a break, 5 minutes, and then we can start up fresh. Okay, and I'll take at least for 1 more hour based on, I wanted to show you some important areas. Okay, so take a break and come back after 5 to 6 minutes. Okay, and then we will start. That's better. Okay, and we'll stretch the class a little. So since you're okay, because there are a lot of things in IMF, World Bank, there are other documents which I wanted to show. Okay, so take a break for 5 minutes, 5-6 minutes, and then we will start. Only for 5 minutes. We'll start in 5 to 6 minutes. Okay, so this was the slide which I have shown you. This is an important slide. Okay. Okay, so this is about WTO, and this is related to TRIMS agreement, trade-related investment measures. But before this, let me show you some document. Okay. See, when we talk about, I think this is visible. Everybody, is it visible? So there were some previous questions on external debt. This is about external debt. So when we look at external debt, the total external debt we take, the major chunk of, so there was a previous question. The previous question is all our external debt is in dollars. That is a wrong statement, of course. Okay, out of the total external debt, major chunk is, out of the total external debt, major chunk is sovereign debt. That is a wrong statement. So first of all, what we should understand is all our external debt is not in dollar. Major chunk of our external debt is in dollar. Here you can see US dollar denominated debt is 54.6, followed by, see, this is a very important thing. After the external debt, first one is US, followed by rupee denominated debt, followed by SDR, followed by yen. You can see this. So in our external debt, the second major component of our external debt is rupee denominated debt. Okay, so this is one observation. Okay, and then out of the total export destinations, you know this, US, UAE, and Netherlands. Export destinations. Then import destinations, China, UAE, US. Okay. This is basically a new BOP classification. So new BOP classification, of course, they may or may not ask. Generally, we talk about current account and capital account. What are the things that fall in current account? What are the things that fall in capital account? But in the new BOP calculation, which is from the 6th edition of IMF onwards, okay, so they have started classifying the BOP into 3 different entities. Like one is the current account, another one is the capital, and then they came up with the financial account. So the capital account was classified separately. One is the capital, another one is the financial account. So that is what you see here. See here, earlier it is like capital account, current account, right? That's it. You know what are the components of current account? You have trade, remittances, income, services. These are all current account, right? In the capital account, you have loans and investments. Okay. So that should be clear. But now here you can see capital account has gross acquisitions, capital transfers, but financial account is separately maintained. In this financial account, you have the FDIs, FPIs. These things are pushed separately. Okay, so that was a basic classification, the new classification that they have come up with. Okay, then these are all previous questions. So this was CDS 2024 question. If you see, observe this question. Anybody wants to try this question, can try this question. See this. 88th question here. It is, which of the following statements are correct? Most of the Indian reserves is held in the form of foreign currency. There is no cost of holding foreign currency as reserves by a nation. What is the answer for this question? Try this question, everybody. 88th question. Okay, so most of the Indian reserves is held in the, yes. So you have foreign currency. When I say forex, major chunk is foreign currency asset, followed by gold, followed by SDR, and then we have the RTP positions, reserve rank key position. Okay, so if foreign currency, that's true. There is no cost of holding foreign currency. There is a cost. It's not free, including the opportunity cost. Cost of holding foreign currency as reserves. It's a cost. Okay, so of course, these things you already know, which are the things which fall in the current account, which of the things fall in the capital account, etc. Okay, so now this is a news basically. So when I look at trade deficits of India, India's external trade, so there are some data which can be important here for prelims. So here you can see WTO World Trade Statistical Review. India ranks 8th in the global agriculture exports. But last 10 years, you know, agriculture export growth was more than 100%. But we have seen the export growth of merchant services also, it was more than 100%. Okay, India ranks 8th in the global agriculture exports, 18th in merchandise exports, and 7th in services export. Largest trading partners of India: China, US, UAE, Russia, and Saudi. You can see here. So on the current. China, US, UAE, Russia, and Saudi. India's trade surplus with US, Netherlands, UK, Belgium, and Italy. I hope you're able to see this. Are you there? Yes. Okay. So the question which I was asking you, this was the question. Can you see which of the above can be included in FDI? This was the question. I asked you this question. Okay, so 1, 2, 3 are included. See, GDRs, no? GDRs and ADRs are part of FDI according to government and FEMA rules. But according to RBI guidelines, RBI takes GDRs as part of portfolio investment. But see the question, which of the above can be included in FDI? The first, second, and third can be included in FDI. Okay, so there is some news about FDI. See, one is FDI in insurance has been changed now. 100% FDI is permitted in insurance sector. This is what is the news right now, that is already there. Okay, so now here about FDI, you can see here, top sources of FDI for India, Singapore, Mauritius, and then US. Sectors which are receiving highest FDI, you have computer software, then services, and then construction. Please keep observing as I'm discussing. Okay, sectors receiving highest FDI, computer software and hardware, service sector, and construction. Then top states receiving FDI, you have Maharashtra, then followed by Gujarat, and then Karnataka. Are you able to see? Okay, so here you have these. Now, FDI equity flows into India, top 3 countries. Then you have services sector. Okay, it's computer. So computer software and hardware, then service, then construction. So you should be knowing this FDI. This was a previous question. FDI is largely non-debt creating capital flow. And FDI is not permitted in lottery, gambling, chit funds, nidhi companies, trading in transferable development rights. Important. FDI is not permitted in lottery, betting, gambling, chit funds, nidhi companies, and TDRs. Okay, and then DPIIT under the Ministry of Commerce is the nodal agency or the nodal department for formulation of FDI policy in India. All these are important for exam. And then what are the things that can be seen as part of FDI? FCCB, FI with certain conditions, GDRs are also can be seen as part of foreign direct investments. This is from where the questions have been asked last time. RBI classifies foreign portfolio investments into FDI if the investment breaches. See, all investment into unlisted company, any investment into unlisted company is FDI only. Into a listed company only, the 10% criteria comes up. 10% of FPI, 10% and above. All investment into unlisted company will be FDI. Okay. Now, this is the chronology of our exchange rate system. So you should be knowing that we have, there is something like the fixed exchange rate system, then the floating. And in that floating, we have free floating and managed float. India follows managed float. So initially when we came up with the par value system. So par value system is where our currency is linked. This is all fixed rate or fixed exchange rate. So par value system linking the currency with gold. Then in 1971, we started pegging our currency with pound sterling. Pound sterling was unstable 1971, and therefore in 1975, our rupee was pegged with basket of currencies. These basket of currencies with which India used to trade, and these basket of currencies, the basket was also not revealed outside to avoid speculation, etc. We're able to follow, I believe. Okay, so then in 1992, we have come up with liberalized exchange rate management system. This is basically 60-40 rule. LERMS is a dual exchange rate system. It came up in the 92-93 budget. It was a transition system from the fixed exchange rate to the floating, in between that. So 60-40 rule, 60% is at market rate, 40% would be government route or government rate. So $1 is 14, let's say, is the market, $1.07 is also there. That is the government. So two rates were there. Government was using the government route for essential imports. So LERMS is a dual exchange rate system. Again, 93, we came up with unified exchange rate system. And from 93 onwards, we have unified exchange rate system, and we call it as dirty float or managed float. So managed float is basically your RBI is going to fix a range. And as long as currency is within that range, RBI will not interfere. But if the currency moves out of the range, then there is a trouble. Okay. So in news again, are you there? Yes. You're able to follow, students. Are you there? Yes, yes. So now let's see, there was this discussion about internationalization of Indian rupee. So you should be knowing about internationalization of rupee. And with respect to this, few concepts you should know. See, internationalization is basically other countries should be ready to, other countries and other foreign banks and in the international exchanges are rupees accepted or they keep rupees. Okay, so India is working towards internationalization of rupee. Okay, India is working towards internationalization of rupee. Okay, so several measures have been taken. But if there is internationalization of rupee, there can be one problem also. If your currency becomes a reserve currency, like for example, US has problems. Since US currency is a reserve currency, everybody keeps US dollar. So what is the problem of US currency being a reserve currency? It is Triffin dilemma. You can see here, there's an arrow here, Triffin dilemma. So if your currency becomes a reserve currency, there can be a problem. This is important. Why? Because Trump was talking about this. US does not have the advantage which the China has. US cannot reduce its value of currency as and when it wants. Because US currency is a reserve currency accepted and held by everybody. So US always has values always on a higher side. So US cannot get that benefit of exports becoming cheaper because of fall of its currency value, because it's highly accepted currency, reserve currency. Everybody keeps and demand is always high. The value of US dollar is always high. So Trump was saying that I will use tariffs as a mechanism to bring parity. I want to have that reserve currency status also, but at the same time, I want to bring some parity with respect to my exports, and therefore I want to use tariffs as a mechanism of balancing the export edge. This is how Trump was trying to support himself. So in that context also, Triffin dilemma was in news. So Triffin dilemma refers to a conflict that arises when a country needs to supply enough of its currency to meet global demand. So since your currency is a reserve currency, you have to try meeting the global demand also. But at the same time, you also have to maintain the domestic monetary policies, which is very difficult. So there is a mismatch here. On one side, you have to maintain the increasing demand of the currency in the international market. At the same time, maintain the domestic monetary policies. So that is a problem. So that is what is Triffin dilemma. In the context of internationalization of rupee, we have also come up with a special rupee Vostro account. So the meaning of Vostro account, special rupee Vostro account. Okay, so Vostro account is an account, see Russian bank basically. So Russian bank account in SBI. Your account in my country or Russian bank's account in Indian bank SBI is nothing but SBI's Vostro account. I hope you're able to follow. Russian bank's account in SBI is nothing but SBI's Vostro account. Now, what is this special rupee Vostro account? So that banks hold for a foreign bank in the former banks here, What is the benefit? So you want, whenever there is a trade happening, so Indian traders will not pay in dollars, rather they will pay rupees in this Vostro account. That is what basically is. Settlement of international trade through Indian rupees is an additional arrangement to the existing system of settlement that uses freely convertible currencies. Okay, so special rupee Vostro account requires prior approval of RBI before opening, unlike rupee Vostro account. So the regular rupee Vostro account is different from the special rupee Vostro account. Okay, so mainly the logic of the special rupee Vostro account is three important, namely you're doing a trade, invoicing, etc., exchange rate, and all the settlement of the trade, everything will happen through this special rupee Vostro account. Okay, so that is basically there in the context of internationalization of rupee. So in the context of internationalization of rupee, there was a special rupee Vostro account. Okay, so in the international organizations, few things which we have to remember. So one international organization which we read is IMF. So IMF, the decision making is based on voting. So you can see the chart. As and when I'm explaining, you just keep observing the chart. In IMF, our voting strength is decided based on quota. And quota, higher is your quota, more is your vote value. Another important observation is the quota will be reviewed for the quotas of a countries would be reviewed once every 5 years. You can see that yellow underlining there. And quota is decided how much quota India has, how much quota US has. Obviously, US has the highest quota in WTO. If you have the highest quota, you can put maximum money on subscription, and you can also remove maximum when required. This is what, and also it will decide the voting rights. And quota is decided based on 4 factors. These are the 4 factors. One is the GDP of the country, which is given maximum weight. And then you have the economic openness, 30%, variability, and international reserves. So 4 factors like the GDP of the country, how open the economy is, economic variability, and international reserves. These 4 factors will decide the quota of a country. And maximum weight in these 4 factors is given to a member country's GDP. So that means by that, when IMF was formed and today, obviously India's quota would have been very less. 0.5% was our quota. And today we are talking about 2.76% quota. This is because our GDP has increased. Okay, so this is what. And the quota is maintained in the form of foreign currency. Currently, they are expressed in SDRs. Now, when we talk about SDRs, what is this SDR? There can be a question in the exam. See, SDR basically is not a currency, special drawing rights. These are reserve assets issued by IMF. So these are reserve assets which are issued by IMF. Okay, so they were issued in 1969. Why? There was too much of demand for dollars, and you wanted to come up with some other instrument which is as liquid as dollars, which can be maintained as reserve. And that is SDR. Are you there? Are you following, everybody? Yes? Yeah. So here, when we talk about SDR, SDR is not a currency. It is only a reserve asset. Like the dollar was maintained as a reserve asset, everybody was maintaining. SDR is also a reserve asset. And IMF launched SDR in 1969 as a reserve asset. And SDR is not a currency, and SDR will not be traded in the international exchanges. SDR is not a currency and not traded on the international exchanges like the dollar, euro, etc. Okay, so SDR is not traded on the international exchanges. It is not a currency, but SDR can be exchanged with 5 major currencies. SDR can be exchanged with 5 major currencies which make up the SDR basket. So what are the 5 major currencies which make up the SDR basket? Dollar, euro, Chinese yuan, Japanese yen, and pound sterling. So 5 currencies which make up the SDR basket. SDR can be exchanged with these 5 currencies. This is one important. So for a particular currency to become part of the SDR basket, 2 criteria are there. One is export. That is the reason Chinese renminbi, because China is a major contributor to global exports. Second is your currency should be a freely held currency. Indian currency is not completely liquid, not a freely held currency, and export criteria is also not there. So now important observation is who can hold SDR. IMF can hold SDR. IMF member countries can hold SDR. And who cannot hold? Individuals, we can't hold SDR. Private players cannot hold SDRs. So SDR, IMF can hold, IMF member countries will hold. Prescribed holders like the regional central banks, developmental banks, intergovernmental monetary institutions, they can hold SDR. But SDRs cannot be held by individuals or private players. They can't hold SDR. And SDRs are used for what? Forex. They are part of our Forex reserve. SDRs are used as loan, take loans. You can borrow in SDRs. Our maximum external debt is in dollar, followed by rupee. Then we have SDR. That means you can take loan also. And then indirect trade. So this is about some aspects of SDR. Now, recent previous question that was asked is the rapid financing instrument and rapid credit facility are part of who issues them. Okay, so these financial instruments are tools of whom? IMF, obviously. Okay, so IMF mainly borrows through quotas, and then there is new arrangements to borrow. So India, from 1990s, India is not borrowing from IMF. From 1990, in fact, India is lending money to IMF. We are a lender to IMF. We're not a borrower from IMF. Okay. So, so recently Pakistan in news, obviously, Pakistan has been bailed out during the war also, 1 billion. Okay, so these questions, I'll show you the question first. There's a rapid credit facility, rapid financing facility are part of who issues them. So some instruments of IMF become important here. So wherever the word credit comes up in the IMF instruments, that is basically for the poor countries. These are concessional loans. The word credit is there means concessional loan. That you have to remember. There is no word credit means it is not a concessional loan. Okay, so IMF has different instruments. For example, standby arrangement, providing short-term financial assistance to countries facing BOP problems. Pakistan relied on standby arrangement. India also earlier borrowed. This is not a concessional loan. This is a non-concessional loan. Okay, standby arrangement. So, okay, so then you can see here standby credit facility. I hope you're able to see this standby credit. So word credit is there, means this is basically a financial assistance to low income countries. And this is part of the poverty reduction and growth trust. That means this is a concessional lending. So IMF also performs the function of reducing poverty. Okay, so that is through this poverty reduction growth trust. And all these credit financing, so standby credit facility, wherever the word credit is coming, this will be a concessional loan given by IMF. Okay, so this is a concessional loan given by IMF. Okay, so then you have extended fund facility. We also borrowed in 1981. Extended fund facilities, so there's no word credit. That means it is non-concessional. So this is given to countries facing medium-term BOP problems because of structural problems, etc. So longer repayment would be there for extended fund facility. Then if you see extended credit, standby short-term, extended long-term. Credit is there means it is low-income countries, poverty reduction growth trust, concessional loan. If the word credit is visible in the instrument. So extended credit facility, medium-term financial assistance to low-income countries with BOP problems. It is under the poverty reduction and growth trust, right? So because the word credit is there, that is important. Okay, so financial transaction plan of IMF. IMF, see, India was selected under the financial transaction plan. So IMF selects some countries with very strong BOP, Forex, etc. And they will contribute, such countries will contribute to the financial transaction plan. We will put money there. We'll give loan. Our Forex earlier reduced to some extent because we have lent money to IMF. Okay, IMF selects countries with strong BOP and forex reserves positions for contributing to financial transaction plan. India was also selected for this financial transaction plan. Okay, so that is about. So in news, there are few things about the World Bank. See, World Bank, one is the World Bank Guarantee Platform. This is in news. World Bank Guarantee Platform. So when we talk about World Bank Group, I'll come to that. And there is this Be Ready Index that is in news. So Be Ready Index is going to replace the World Bank's Ease of Doing Business Index. Okay, and this Be Ready Index is going to replace the Ease of Doing Business, and Be Ready Index takes certain things. These are the things which it takes into consideration. Okay, so business entry, business location, utility services, labor, financial services, all this. So Be Ready Index is given by, Be Ready Index is going to replace the World Bank's Ease of Doing Business Index. So when I look at World Bank, obviously international organizations, so World Bank, you have 5 major institutions. You can see here, IBRD, IDA, IFC, MEGA, and ICSID. You can see 5 entities under the World Bank group. In these 5 entities, India is not a member of ICSID. We are not a member of ICSID. We are a member of 4, IBRD, IDA, IFC, and MEGA. I hope these things are clear for everybody. Students, you're able to relate? Yes? Okay, so India is not a member of ICSID. India is a member of MEGA, IFC, IDA, and IBRD. So one important observation. IFC was the first institution to issue masala bonds. This was a previous question, already asked. Okay, so if you look at this chart, India is not a member of ICSID. You can see here, India is not a member of ICSID. That is one thing which we will remember. Okay, then IBRD was the first entity that was established for post-war reconstruction, etc. India is a founding member. Okay, and you know Bretton Woods twins are World Bank and IMF are also Bretton Woods twins. Okay, and decision making in these IMF and World Bank is based on voting procedure. So only IBRD gives loans to gives loans to middle income and credit worthy low income countries only. Observe this. IBRD gives loans to middle income and credit worthy low income. That means those countries which are not credit worthy, they have to take loans from IDA, International Development Association. You have to take loans from IDA, not from IBRD. So IDA gives soft loans, less interest, and long-term, you can call them as grants. Okay, so that is what IDA does. India was a blend country, borrowed from both IBRD as well as IDA. Okay, IFC, see here, IFC primarily focuses exclusively on private sector in developing countries. Focusing on private sector. In developing countries, provides loans to private companies rather than governments. It provides loans. IFC provides loans to private companies rather than to governments. And IFC floated rupee bond and masala bonds for the first time. Okay. Then you have MEGA. You can see Multilateral Investment Guarantee Agency. So this MEGA primarily it tries to protect the investors from non-commercial risk. Protect the investors. See, they'll not invest in certain countries because there is, forget about commercial risk, there's non-commercial risk also. Non-commercial risk can come in the form of war and civil disturbance. They're not honoring the contracts. Financial obligations are not honored. Okay, so or these breach of contracts. So these are all what these are basically non-commercial risks. So MEGA basically guarantees protect investments against non-commercial risk and can help investors obtain access to funding sources with improved financial terms and conditions. So therefore, investors can invest because there is some guarantee that is coming from the MEGA, and therefore they can invest in these countries where there is a lot of other problems other than the commercial risk. So this is, and India is not a member of ICSID, as I mentioned. India is not a member of ICSID. So this is a brief understanding of. So then we can get into the question. Okay, fine. So WTO, it's very difficult to discuss WTO in detail. So WTO, there are several agreements in WTO, like the TRIPS, GATS, GATS, agreement on agriculture. But most important is agreement on agriculture. So agreement on agriculture divides the agriculture subsidies, and it focuses on domestic subsidy, export subsidy, and free trade or improved market access. So the domestic subsidy of three different boxes, one is amber box, blue box, and the green box. And all trade distorting subsidy is made part of the amber box. I think most of you should be knowing. And in this amber box only, we have that MSP also. And therefore, you should keep the subsidies below a certain limit, which we call it as the de minimis level. And this de minimis level for the developing countries is 10% of their agricultural GDP. And for developed countries, it is 5% of their agricultural GDP. So WTO basically different agreements. So out of those agreements, one of the agreement is TRIMS, trade-related investment measures. In that TRIMS agreement, one important observation is it talks about, so TRIMS agreement foundation is coming from national treatment concept. The way you treat domestic entities, and similarly you have to give national treatment to the foreign entity. So TRIMS comes from the national treatment concept and also investment related aspects. TRIMS is only for goods. TRIMS agreement does not cover services. So based on this aspect, so services is basically handled by the GATS agreement, General Agreement on Trade and Services. Okay, so based on this logic, this question was asked. This question was framed. So try answering this question. Yes. So question visible. Try, since we have discussed those institutions now, some aspects you have to try this question now. Of course, WTO have not discussed. WTO discussion very difficult because it's too lengthy. But your focus should be on agreement on agriculture. See this, they apply to investment measures related to trade in both goods and service. This is wrong. Second statement is wrong. So TRIMS agreement is only for goods. It's not applicable to services. Okay, and the other two statements are okay. They're not concerned with the regulation of foreign investment. So TRIMS basically focuses on four things actually. Local content requirement, trade balancing requirement, export restriction, forex restriction. Okay, so TRIMS basically focuses on four things. Okay, so what are the four things TRIMS focuses on is, one is local content requirement, trade balancing requirement, export restrictions, and forex requirement. Okay, so I've discussed anyhow. See this rapid financing, rapid credit. Pakistan in news now, check that. So these are, rapid is very fast, immediate credit. But rapid credit is there means concessional. Poverty reduction growth trust. Rapid financing, non-concessional, immediate loan. So obviously, it is basically IMF, what we have discussed from the discussion we had. Okay, so this is about, this was in news with reference to G20 common framework. Consider the following statements. Okay, so here basically Chad became the first country to officially request a debt restructuring under the new G20 common framework. Okay, so you can go back and read this once. G20 common framework. Okay, we will not ask again because already asked. Okay, so move on to the next question. You can guess this question. I want you all to try and guess this question, everybody. Try guessing this question. Yes. Answer. Yes. This should be World Bank, obviously. 1 and 3 is the answer. Okay, sometimes clues will be there in the question itself. We should not panic. Okay, so there is this population and demography, some simple questions only, but I will discuss some concepts. So first, let's see the questions and then we'll go to the concept area. Okay, so see this. Total fertility rate in an economy is defined as. Okay, so this is basically the average number of live births a woman would have by the end of her childbearing age. Simple question from NCERT. Okay. Try answering this question. Simple question. Question visible on the chart. Easy question. Try marking the answer. Everybody. Answer. This is 4, level of mutual trust and harmony in the society. Not an economics question, but simple question only. Considered as part of social capital. Okay. So the next one is this topic, poverty development. So most of the schemes are given. Old schemes will not be given now. But what you should do is see schemes, you have to read those schemes mentioned by the president's madam in her speech. That is where questions are being framed. Questions are being asked from that area. Okay, so before that. Okay. So Human Development Index, Multidimensional Poverty Index. Okay, so Multidimensional Poverty Index also have 3 indicators, 3 and you have 10. National Multidimensional Poverty Index, now you will tell me in the National Multidimensional Poverty Index, how many indicators are there? National Multidimensional Poverty Index, how many indicators are there? 12. What are the 2 other indicators which are not there in the Global Multidimensional Poverty Index? Put it in the chat immediately. 2 extra are there, no? What are those 2 which are not there in the Global Multidimensional Poverty Index? Put it in the chat. Put it in the chat box. What are the two things which are, one is the bank account, very good. Then second one, maternal health, very good. So these are the two indicators which are not there in the global multidimensional poverty index, which is there in the national multidimensional poverty index. Good. Okay, so when we talk about inequality, you should be knowing few concepts. What inequality is a state of not being equal with respect to income, expenditure, wealth. This is economic inequality. It can be religion, region, gender, that is social inequality. So in economics, we are mostly concerned with economic inequality. But economic inequality can lead to social inequality. Social inequality can lead to economic inequality. Three entities which are used for measuring inequality. One is the quintile ratio. And then you have the Palma ratio. And you have the Lorentz curve and Gini coefficient. So these are some indicators which are used for measuring. So quintile ratio is what? Top 20% of the population you're measuring with bottom 20% of population. Okay. And Gini coefficient is measured using Lorentz curve. So Gini coefficient varies between 0 to 1. When Gini coefficient becomes 1, maximum inequality. Okay. So 0 Gini coefficient, it is line of absolute equality. Okay. So when Gini coefficient becomes 1, it is highest inequality. I hope it is clear. Okay. So Kuznets curve basically talks about measuring inequality and income per capita. Here you can see as and when income per capita is increasing, inequality is increasing up to this point. Okay, up to this point, you can see this. And then after that, only there is reduction in inequality. Okay, so that is about Kuznets curve. Okay, so okay. So when we talk about poverty, so one is poverty headcount ratio. Headcount ratio measures the incidence of poverty. What percentage of population are falling below poverty line? That is what is headcount ratio. Poverty gap ratio. What is poverty gap ratio? Poverty gap ratio measures the intensity of poverty. So it is nothing but poverty line minus the average monthly consumption expenditure. Average monthly consumption expenditure of BPL divided by poverty line multiplied by 100. So how farther away you are from the poverty line, that is what is checked. So now you should be, this will measure what? This will measure intensity of poverty. This will measure incidence of poverty. So how is poverty line? So one, you take a basket of necessities. Take a basket of necessities, get the market value of this basket. And if let's say this basket is 413 rupees, all those whose monthly per capita consumption expenditure is less than 413, you're calling them as BPL. So taking average monthly consumption expenditure of all those below BPL. This is the poverty line minus average monthly consumption expenditure divided by poverty line multiplied by 100. This will measure what? Intensity of poverty. Now there were different committees. Are you able to see? Everybody is able to. One second. Everybody is able to see the committees. Okay. So see, when we talk about different committees for revision here, in CDS, they have asked Suresh Tendulkar. See, Suresh Tendulkar is the most important committee, which you have to remember. Okay, so some basic observations here. So one is the first systematic assessment of poverty estimation was done by Dandekar and Rath in 1973. Okay, this is not here, it's not mentioned, Dandekar and Rath, which took 2,250 calories per day as standard, Dandekar and Rath. Here you will find Alag committee. Alag committee came up with separation for urban and rural. You can see here urban 2,100, rural 2,400. First time that separation of calorie requirement for urban and rural was done by Alag committee. Okay, so that is what you will observe. Then 1993, Lakdewala committee, two important things. What you will remember. One is 2,400, 2,100 as like the Alag committee. But one thing which you will remember is state-specific poverty line. Lakdewala committee says come up with state-specific poverty line. Suresh Tendulkar committee makes very important. So Suresh Tendulkar committee, what he does. So what he suggests, first thing is shift from uniform recall period method to mixed recall period. I think everybody knows this. So 30-day recall period only for every item, food and non-food. Mixed recall period is 5 non-food items. It is 365 days. Rest of the items, it is 30-day recall period. So then he says proper linking with inflation. Then take education and health in the poverty line basket. Okay. And he also suggests the same poverty line basket, which is the urban poverty line basket. Take the urban poverty line basket and use it for rural also. Uniform poverty line basket, he says. Uniform poverty line basket, unlike the earlier. Okay, he did not he did not calculate it completely new. What Suresh Tendulkar did, he took the Lagdewala data only and he used MRP. And that's how he came up with the data. I hope it is clear. Okay, then Rangarajan Committee 2013, Rangarajan basically used modified mixed recall. So in modified mixed recall period, you have three things. You have 365 days, those 5 non-food items. And also you have 30-day and 7 days. Mixed recall period, modified mixed. He uses modified. So one more important observation is Rangarajan for the first time, he reduces the calorie requirement and he talks about protein and fat. You can see that. Protein and fat. Okay. Then he also, like the earlier committees, he says uniform basket, not like Rangarajan. Uniform poverty line basket. He says don't follow uniform. That means what he says is earlier Rangarajan says Tendulkar committee follows uniform poverty line basket. Okay, so he says like the earlier committees, we will follow a separate poverty line basket for urban separate, rural separate. That is what he says. Okay, so within this time we can't spend much time. So these are the committees, and most importantly, you should be knowing Suresh Tendulkar. Okay. So multidimensional poverty index is important. Okay. So how many of you are okay? Are you there? Is it helping you, like glancing through that those slides? Is it helping you, or is it okay, students? Okay. Fine. So next is you have this topic unemployment. Of course, unemployment. Let's see the questions that they have asked. We'll go to the questions, UPSC questions, but so few concepts should be very clear. One is unemployment rate. How is unemployment rate measured? Okay, so all those who are between 15 to 51 are looking for work but no work, divided by labor force multiplied by 100. Okay, so that's how we measure the unemployment. Person who is capable of working, unable to find work. But what is labor force? 15 to 59 who are already working plus who are looking for work. Then labor force participation. Labor force participation rate is labor force divided by working age population. Labor force divided by working age population. Working age population. Okay, multiplied by 100. This is the labor force participation rate. Then worker population ratio. Those who are working to the total population. Those who are working to the total population, this is worker population ratio. Labor force participation rate, unemployment rate. Okay, employment elasticity. Now, percentage change in employment to the changes in GDP. Percentage change in employment to the changes in GDP. Falling employment elasticity indicates what? If the employment elasticity is falling, what does it indicate? Anybody? If employment elasticity is falling, what does it indicate? So if employment elasticity is falling, it indicates what? It indicates jobless growth. Okay, it indicates jobless growth. Simple. So why? Because it is nothing but proportionate change in employment to proportionate change in employment to proportionate change in GDP. So the numerator is not increasing, though the denominator is increasing. Okay, so that is indicates what? Falling employment elasticity indicates jobless growth. So this is how unorganized sector is defined. Types of unemployment, I don't think you should be knowing, right? Disguised, structural. Two types of unemployment which cannot be removed from any economy. These are the two types of unemployment which can never be removed. Structural unemployment is a mismatch between skills the job requires and skill sets which the individual has. This is hopping between jobs or search unemployment. Frictional is search unemployment, right? Okay, so these are the two types of unemployment which can never be removed from any economy. They will persist though the economy is growing at its peak level. So for measuring unemployment, we have different methods. One is the usual status, current weekly status, and CDS. And you should be knowing PLFS survey, Periodic Labor Force Survey 2017. Check female labor force participation rate, last 5 years, increased, decreased, etc. Check unemployment rate, obviously reduced. Okay, so these things have to be checked in the latest PLFS, Periodic Labor Force Survey. See, Periodic Labor Force Survey also uses these two methods. Which two methods? These two. Okay, so usual status, you have usual status. In this usual status, you have usual principal status plus subsidiary status. PLFS uses this. So what happens in usual status? The reference period is 365 days prior to the date of survey. And if somebody is working for more than 6 months, he is given employed status. But here intermittent unemployment will not be checked. What is the meaning of intermittent unemployment? You're working for 1 month, then you're idle, then you're working, then you're idle. That is not checked. But if overall, if you're working for around 6 months, then you're given employed status. This is about usual principal status. Subsidiary status. What is the subsidiary status? In 365 days, if you are employed for 30 days also, 30 days also, you are given employed status under subsidiary status. Okay. Then current weekly status. So 1 week reference period prior to the date of survey. Okay. If you are working for 1 hour on 1 or more days in those 7 days. In the 7 days reference, if you worked for 1 hour also on 1 day also, you are given employed status. Current daily status, what do you do? It is also 7 days reference. But here, on each day, you are going to check. On each day. Okay, so if he is working for one hour, but less than 4 hours, it is treated as you are employed for half a day. But if you are work for at least 4 hours and above, it is treated as you are employed for the whole day. Full day. So these are the 3 methods. PLFS survey uses these two, usual and current weekly. Everybody should be knowing this. Okay, so Phillips curve talks about an inverse relationship between inflation and unemployment. Tell me the answer for this question. That's about poverty, unemployment, inequality. Tell me the answer for this question. Of course, one more answer. Good. D, no. Price level. Because they have to be linked to inflation. This you can answer. This is a simple question only. This is also simple. Okay. Okay. So, of course, this question, this is a scheme. Since they have asked in 24, they will not ask this question. Okay, so schemes basically go back and read those schemes which are part of the President Madam's address. What is the answer for this question? Okay, see the question. answer. Okay, good. Both are correct, but not the correct explanation. Good. Of course, there is this question. Now, again, this will not be asked. But again, back, see here. But still, just for reference, consider the following statements in the context of interventions being undertaken under Anemia Mukt Bharat. So, anemia, obviously, instead of calcium, it should be iron and folics. Okay, so that is how you should be able to eliminate this option. And then rest you can see. That's how many times, without knowing anything, also you can mark the answer. That's very important. Understanding the words in the question. Words in the question. So this is again a scheme. President Madam speech you can read. With reference to Digital India Land Records Modernization Program, consider the following statements. Okay. So this is again factual statement. All are right. Small farmer, large field. Everybody, I think you should be able to answer this question. Tell me the answer for this question. Okay, I've marked the answer already. Okay, so many marginal farmers in an area organize themselves into groups and synchronize and harmonize selected agricultural operations. That is what is small. The word itself, no, you based on the word, you can mark the answer. Small farmer, large field. Factual question. See, recently, I think there is some tobacco. Oh, okay. So T Act, so the statutory body, only one, the statement here, this is wrong statement, you can see here. Well, statement. This is an easy question. There should not be any trouble marking the answer. Please read and mark the right answer. Check this question. Everybody is able to mark this? Yes. C is the answer. 2, 3, and 6. Other things are not considered public investment, obviously. Observe carefully. Simple question, but important. Okay, so planning actually, you have time, 10 minutes. I will do planning from a document. So, students, are you okay? If I take another 5, 10, okay. So, it's been a long time. So, just thinking you're getting. Okay, so when we look at 5-year plans, so few things which you should be knowing is obviously imperative planning. Imperative planning is what? Centralized planning, right? Centralized planning and generally followed in socialist economies. Then we have indicative planning, right? Indicative planning, 8th 5-year plan, we have come up with this flexible planning or indicative planning. So where there's more of decentralization, generally practiced in mixed economies. Currently, Niti Aayog follows perspective planning, long-term planning, 15 to 20 years, etc. Then rolling plan, Janata government came up with rolling plan around 1978. And rolling plan, basically, you have 3 plans in one go. One is the annual plan, annual budget. Then you have a medium-term plan, 3 to 5 years. And one would be a long-term perspective plan for 10, 15, and 20 years. Okay, but it did not last. Rolling plan did not last because again, 1980 Congress government came up. Okay, so that's what happened. So to remember, see what were the questions that were asked earlier and how do we deal with it? For which I'll tell you one small technique. Okay, so these are the you can't remember everything, obviously. So what we can do is remember that first of all, for example, if they ask you like FCI was set up during which plan? Okay, so first of all, I should know. So you have 3 plans and you have 3 plan holidays. Okay, then you have 2 plans and you have rolling plan. And 6th plan again starts from 1980. Again, you have 2 plans. Okay, this is 1980 to 1985, 1985 to 1990. Okay, you have 2 plans and again you have 2 plan holiday, 1990, 91, 91, 92. 2 plan holiday, 2. So 2 plan holidays are 1990, 91, 1991, 92. And then 8, 9, 10, 11, and 12. This is how it goes. So this is 8th plan starts from 92 to 97. Then it is all continuous only. So like that, you have to remember these numbers are 3, 2, and 2. That is basically you have 3 plans, you have 3 plan holidays, then you have 2 plans, 2 rolling plan. Then again you have 2 plans, and then 8th plan. 8th plan starts from 90 to 97. That's how you have to remember first. So this is basically, then it is easy. 51 to 56, then 56 to 61. Okay, then 61 to 66. Once you know this, FCI was set up in 1965. So FCI was set up during 3rd plan. Like that is how you have to remember. Okay, NABARD came up during which plan? NABARD came up during sixth plan. Sorry. Okay, so that is how you have to come up with. Okay, so here first plan is based on Harrod-Domer model. We focused on agriculture, but nothing significant happened. Second plan, Nehru Mahalanobis. Okay, and rapid industrialization, self-reliance, investment in heavy capital good, etc. Okay, so IPR policy also came up during this period. Okay, 1956 IPR policy basically. Bible of all industrial policies till 1991. Okay, third plan was the worst plan where our performance was very bad. Okay, so see the growth, actual growth. So 1961 to 66, third plan. So after this plan was so bad that we required plan holiday. 3 plans, then 3 plan holiday. 3 plans, 3 plan holiday. So in the third plan only, India resorted to borrowing from IMF, devalued our currency in 1966. All this during FCI was set up, third plan. Okay. So then 3 plan holidays. During this plan holiday only, we came up with this first green revolution. Okay. So fourth plan, then 3 plan holiday, 4 and 5 you have. Okay. 4 and 5, but emergency declared and the plan was terminated. Rolling plan came up, Janta government. So rolling plan, what is rolling plan? 3 separate plans, annual plan, medium term, long term. Okay, so but did not last much. And then sixth plan started 1980. So that is what you have to remember. So remember 3 plan holiday, 2 plan, 2 rolling plan, then sixth plan starts from 1980. So sixth plan started from 1980. So what were the questions that they have asked? So one is C, plan was adopted with the slogan Garibi Hatao. This was previous question. This was the previous question that was already asked. In which plan there was a shift from industrialization towards infrastructure? That is sixth plan. Okay, so that is what NABARD was also established 1982, sixth plan only. Exim Bank also. Okay, then seventh plan, 6 and 7, then 2 annual plans. And that's how eighth plan started off from 1992. 1992. So this is what indicative planning, flexible planning. Okay, so there was a shift from imperative to indicative planning. Eighth plan, growth was good, but social spending was neglected in this plan. Okay, then 9, 10, 11 and 12. So everybody should be knowing 11th plan. Basically, see here, one more thing. Sixth plan, there was a shift from industrialization towards infrastructure. But seventh plan is called as infrastructure plan. Both are different. This was the previous question. Sixth plan, there was shift from industrialization towards infrastructure. Seventh plan was termed as infrastructure plan. Okay, then eighth plan, LPG. Okay, BOP, all that prices, etc. Then 9, 10, 11 and 12. So 11th plan was implemented amid global financial crisis. And this was basically first time ever so much of the plan expenditure was on social sector spending. Why? Because inclusive growth was the primary target in this. So the theme of the 11th plan was towards faster, more inclusive growth. See, only in these plans, we have achieved more growth than the targeted growth. 1, 5, 6, 7 and 8. Only in these plans, we have achieved more growth than expected. Okay, so that is all the rapid revision. Of course, it's a little difficult to do it, but I hope I added some value in your preparation. Okay, so I wish you all the best and keep revising. Okay, so that is about the planning part. One second. Okay, so there are some current words which I can give you, but which you have to do some research. Can you do? I'll give some words. Ah. So you just stay online. So I've noted down some words which are important, which you'll just read what the word stands for, and then you can leave it. As I was mentioning, so you can just make a note of it. We don't have time, so just make a note of few words. So one is PSL. I've talked about PSL. So you have to read about PSL and PSL certificates. Keep noting down. I'll leave you by in 5-10 minutes. Okay, PSL and PSL certificates. Okay, so then perpetual bonds. Perpetual bonds. Okay, perpetual bonds, right? Or 81 bonds, 81 additional tier 1 bond. Okay. P notes, anyhow, carry trade, CARRY. It's in use because of Japan. You can take loan at lesser interest from Japan, and you can buy assets in other countries like US. This is called as yen carry trade, which is in newspapers. yen carry trade, CARRY, carry trade. I hope you're noting it down. Okay, so keep noting it down. Okay, then external trade, I showed you maximum trade we do with which countries. Okay, so surplus countries, and then other FDI, maximum FDI moves where, which are the things which fall under FDI? Repeat all of them. I don't even remember here. Carry trade was one, perpetual bonds was one. Okay, yen carry trade, perpetual bonds or additional tier 1 bonds. Okay, so special Vostro account, anyhow, I've discussed, so I'm not mentioning that. Special Vostro account, already we have discussed. And trade, we have discussed the chart, no, external trade, our export increased last 10 years. Okay, so which area of maximum export? Services more than 100. The PIB document which I showed you, that is also important, that you have to keep in mind. Then special rupee Vostro account. Please make a note of that, special rupee Vostro account. Then components of GFCF, gross fixed capital formation. What are the things that are included in GFCF? What are the things that are excluded? For example, losses due to natural disasters, etc. They are excluded from GFCF. Okay, so that is all. Yeah, everything would be shared. Don't worry. Okay, so and then multidimensional poverty index, then read about middle income trap. See, there was a lot of discussions that India will be in middle income. India is a lower middle income country, you know this. China is a higher middle income country. South Korea is a high income country. So criterias you read and why. Then Preston curve, Preston, Preston curve. What does it talk about? See, we see Kuznets curve, Lawrence curve, Laffer curve, Phillips curve. Okay, so like that, Preston curve, Preston curve. And Nobel Prize in Economics, if you want, economic institutions, etc., just see what are that, how institutions are going to affect prosperity, etc. This was what the Nobel winners were talking about. So they were talking about inclusive institutions and extractive institutions. Inclusive and extractive institutions. So what are these extractive include? Just go through. By chance, if there is a question, you should be able to mark the answer. Agriculture export policy. See, agriculture export policy, why? Because last year we could not increase the agri export. It went down. So suppose if I ask you like, you can open your mobile and tell me the answer. Let's say last 3 years, did agriculture exports consistently increase? You check right away. Check right away and put it in the chat. Check right away. Last 3 years, did agriculture export consistently increase? able to get that. What happened? Not able to see, not able to check. Not increase. Last year it decreased because of government. So 2018 agriculture export policy is already there. There's a discussion on agriculture export policy. So go through that. Edible oil sector in India. You see, in budget, there was Atma Nirbharata with respect to pulses and edible oil. Okay, now another question to you all is Makana board in budget. See, Makana board is set up in Bihar. Which state is the largest exporter of Makana? Which state is the largest exporter of Makana? Though Makana board is set up in Bihar, the largest exporter of Makana is not Bihar. So these are basically trap-based questions. So largest exporter of Makana is Punjab. Okay, so these can, and is there any Makana which has GI tag? Any Makana which has GI tag? You have to be fast. Any Makana which has GI tag? Mithili. Taking so much time. Okay, so in budget, there was a discussion. See, budget runs on 5 growth engines, right? So one is MSME, and MSME, go back and check the new classification where the investment has been increased by 2.5 times. MSME, micro, small, medium, and the turnover has increased by 2 times. Then trades, Mithila, right? So, and trades program of MSME. So MSME is one more problem is MSME is not able to get cash, immediate cash payments, cash block, all that is there. So TREDS trades program, which is there in the economic survey. So go and check the trades program, new classification of MSME, Atma Nirbharata with respect to pulses and edible oil. So edible oil check. See, India maximum edible oil we buy palm oil. So maximum palm oil we buy from which country? See, we buy maximum palm oil from outside, followed by soya bean. Palm followed by soya, and maximum we produce is mustard. Maximum we produce is mustard. We import maximum palm. There was a drastic reduction in palm oil, but still it is high. So that was the reason it is in news. So edible oil sector is in discussion in India. Millets also, Sri Anna is in news. Okay, so go back and see what is this millet. Is that okay? You're able to get it, you're able to write. Is there a GI tag rice? GI tag rice. Which one? There is a GI tag wheat also. If you're seeing that, what is that cooking every day at home, they come up with this program. Master Chef. Every day is talking about GI, 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 GI. Okay, so right, wheat is also there. You have a GI tagged wheat also. Okay, you have a GI tagged wheat also. And you have GI tagged Makana also. Largest exporter of Makana is not Bihar, Punjab. Check that. Largest producer of Makana is Bihar. Makana board established in Bihar. Okay, fine, good. Okay. So we don't have much time, so see, there was a previous question on casual workers. Now, one question to you all is, do casual workers, are they entitled to regular working hours and overtime payment? Are casual workers entitled to regular working hours and overtime payment? First of all, you know who are casual workers? See, hired workers can be divided into regular workers and casual workers. Okay, see, casual workers are those workers who are not on the permanent payroll of the company. However, casual workers are entitled to regular working hours as well as overtime payment. But casual workers are not entitled to all the social security benefits. So this is what differentiates a casual worker from a regular worker. Okay, so there was a differentiation question already asked. Then you should also know informal, formal. How do we define? Organized, unorganized. What is the definition? Okay, so NCEUS defines unorganized sector. Okay, so how do you define an unorganized sector? Suppose a private entity is there where there are less than 10 employees, etc. So that is also you call it. So in a organized sector also there can be an informal worker. So these things, some clarity. Okay, Be Ready Index. Be Ready Index I mentioned, but go back and see. Be Ready Index is going to replace the Ease of Doing Business Index of the World Bank. Okay, so that is one. Then angel tax completely removed by the government in the previous budget. So angel tax. You don't have angel tax on startups now. So that is something. And then PM Gati Shakti master plan, of course, in which you should know. Major and minor ports and critical minerals in news. See, critical minerals, China, domination of China. How are critical minerals different from rare earth? So critical minerals are important, and also read major and minor minerals in news. Major, minor minerals, it was in news. And then see, IRIDA company was given, I think IRIDA was given Navratna status. So you'll check the criteria of Maharatna and Navratna. So when we talk about companies, in industry, like Navratna, Maharatna. So what are these Navratna, Maharatna? So why? Because they are in news. Some companies have been allotted, like IREDA, IRIDA has been allotted uh, Navratna status, as far as I remember. Okay, so go and check that. Coal sector in India. See, there was a previous question also that India imports coal. Yes, India imports coal. Why India imports coal? Because we don't have anthracite or maximum of anthracite, bituminous, high quality coal is not there. So coal reserves, coal sector, that again becomes important. So coal sector in news, so that you will read. There was a previous question already asked. Space economy, FDI in space, FDI in insurance, FDI in space, FDI in insurance in news. Okay, so just see technical textiles. Technical textiles. So I think everybody should be knowing what are technical textiles. No aesthetic value, but for functional use. So these are called as technical textiles, right? So that one is important again. Index of 8 core industries, as I mentioned, and index of industrial production. Index of industrial production, index of 8 core industries. Then see Nidhi companies. So for example, do you need RBI license to set up a Nidhi company? Now a simple question to you all, almost done. Do you need RBI license to set up a Nidhi company? What are Nidhi companies? They borrow among themselves only. They can't give loans to outsiders. And you don't need an RBI license to set up a Nidhi company. FDI is not permitted into Nidhi company. Okay, so Nidhi company should know, as you know, the difference between bank and NBFC. Now, one more question to you all. Do NBFCs maintain capital adequacy ratio? Do NBFCs maintain capital adequacy ratio? Everybody knows capital adequacy ratio, total capital to risk weighted assets. As per Basel 3, 8%, as far as RBI is concerned, 9%. Right. Do NBFCs maintain capital adequacy ratio? Please put it in the chat box, those who are there. See, NBFCs require capital. NBFCs have to maintain capital adequacy ratio. NBFCs need not maintain CRR and SLR. NBFCs need not maintain CRR, SLR, but NBFCs have to maintain capital adequacy ratio. Is that okay? Okay. So these are some words I could recollect the note, some words which I've noted down. Okay, so I think that should be sufficient, and I wish you all the best. Thank you, and I hope you revise things well.